Okay.
Yeah, yeah.
Good morning, bankers.
Good morning, sir.
Very good morning to all of you. My location is slightly changed. Now I am in Singapore.
Yeah, sir. Yes, sir.
I came for a short visit to my son's house. So I'll be back next week. I'll be back. Okay. So in the meantime, some of you, as Biju told, I am known to you. So if you want to talk something on anything regarding international banking or treasury management, you can have a discussion with me until our academic director, Mr. Mohan sir, joins. Okay. If you want any specific suggestion how we have to proceed, because in another 12 sessions, I will be completing the international banking. 12 sessions mean today 2 sessions, next Sunday 2 sessions, then next Saturday and Sunday 4 sessions, like that. So total put together, no, not 12 session, 8 session, 8 session and 12 hours will be completing international banking, and then another 4 or 5 sessions will be completing the treasury management also. After what I plan is, after completion of each session, I'll be sharing the relevant PPTs. If you want it in advance, I can do it. But the thing is, if I forward the PPTs in advance, you will be looking at the PPTs and without listening to what I am talking. So that's what I felt. After completion of the session, I'll be sharing the PPT. Is it fine?
Yes, sir.
Okay. So as far as this paper is concerned, this module A and C, and that means international banking as well as treasury management is concerned. We cannot predict how the paper comes before you, because there are a lot of numericals as well as theory. So sometimes they will be concentrating more on theory and less on numericals. And sometimes it will be more on numericals and less on theory. So that means the pattern of the exam, the question paper cannot be predicted in advance. So you have to prepare it for the worst situation. That means, what is the worst scenario? Prepare the whole. That means don't leave anything unturned, untouched. Concentrate on the theory. Unless you know the theory and the important concepts, you cannot work on the numericals. So first, understand the concepts, important concepts in theory, and then you can proceed with the numericals. As far as the numericals are concerned, see, you have to learn it by doing the maximum number of questions. That is my recommendation. Try to do the maximum, any number of whatever sources. You can have a lot of questions, because IBS has prepared a study material, written study material, wherein there are a lot of numericals are there. From foreign exchange arithmetic, some 10, 20 numericals are there, as well as in treasury also, a lot of solved numericals are there. You can try to look into it. In addition to that, you can search for the numericals in the Macmillan publication, IABF publication. There also, so many questions are there. Try to solve those questions. In addition to that, discussing some types of questions in this session, and those you can repeatedly concentrate. In addition to those, if you are interested, I have prepared some 30-40 questions. That is in 3 series: exercise 1, arithmetic exercise 1, 2, and 3. If you are interested, I can share. First, afterwards you look for Matzo one by one as you progress in studies. This is what I propose. Now, I would like to have a feedback from you. If you have any other suggestion, you can tell it now. But my experience.
As we are going to start the international banking from today, it is my humble request that start just like a fresh batch. Actually, you think that we don't have any idea about the international banking, then you have to start.
No, I'm not clearly audible. See, you mean to say that you are the beginner in this topic, isn't it?
Yes, sir.
Okay. See, I'll be touching from each and every basic points. The important points I'll be touching. But now the days are very limited. You have around 40 days ahead for the exam. Am I correct? So this 40 days, say completing the entire topic for a fresher, it will be very difficult unless you devote a lot of time, minimum 6 hours a day. You may not be possible to cover if you're a beginner. But if you know some of the aspects, some of the things, and you want to clarify it, you can spend 3 to 4 hours a day. That will be enough. So for a starter who doesn't know anything of the topic, international banking as well as treasury management, risk management, and balance sheet management, then you will have to spend more time on that. Because if we cannot provide you a panacea, something like that, we just swallow it and reproduce it. It's not possible. Because the subject is very vast, the topic is very vast, lot of changes, lot of new information, and the terminologies, you will be coming across with a lot of new terms, and therefore it will take some time to familiarize the things. That's what, for a beginner, this is too late to start. But if you have little knowledge on this, and for a beginner also, I can support you, provided you devote minimum 5 to 6 hours a day on this topic. Otherwise, I think it will be difficult. Because the topic is so vast. And another point to remember, see, our director, our executive director, he had a discussion with the IABF officials. And from them, we used to know that every time they used to ask some 5 to 10 marks question out of text. What is the meaning of that? Because Macmillan publication, they have come out with a text, and based on this only they are asking the questions. But the thing is, they can ask some 5 to 10 marks question out of the text. That means those will be pertaining to the latest changes and the current economic scenario and what is discussed in the budget. So budgetary announcement, latest changes, and what is happening in the Indian economics scenario. So those questions connected to those also can be asked. Therefore, you can make sure that from the text, you can expect 90% of the marks, means 90 marks, 90 to 95 marks. So out of 95, your scoring, your passing percentage is 50. That means to get 50 means you should aim for 100. If you aim for 50, you will end up with 30, 35 or 40 or 45. So aim for 100, prepare the whole, don't leave any topic untouched, and aim for 100, you may end up somewhere in 55, 60 or 65. It all depends upon your capacity of grasping the things and the memory power which you can reproduce in the exam. Mohan sir.
Very good morning,
sir.
Good
morning, sir. Good morning.
Yeah, very good morning, sir. How are you, sir?
Good morning, sir.
Fine.
Very good morning. Very good morning.
Good morning, sir.
സാർ ഇത് തുടങ്ങുന്നതിന് മുമ്പ് ഒരു കാര്യം ചോദിച്ചോട്ടെ. നമ്മുടെ ഈ പിന്നെ തിരുവനന്തപുരത്ത് JIB മോഡ്യൂൾ എയിലെ സാറ് പിന്നെ ഇൻട്രസ്റ്റ് പോർഷൻ തീർത്തല്ലേ? പിന്നെ ഇന്ന് വേറൊരാൾ എടുക്കുന്നുണ്ട്, അപ്പൊ ഞാൻ അതൊന്ന് പറഞ്ഞേക്കാം. ഇൻട്രസ്റ്റ് അവസാനത്തേക്ക് മാറ്റാൻ പറ്റില്ല. അപ്പൊ പിന്നെ ഒരു ദിവസം കൊണ്ട് തീർത്തിട്ട് അവസാനം ഇൻട്രസ്റ്റ് പോർഷൻ പറയാൻ സിമ്പിൾ ഇൻട്രസ്റ്റും കോമ്പൗണ്ട് ഇൻട്രസ്റ്റും പഠിപ്പിച്ചായിരിക്കും അല്ലേ?
അത് ആന്വിറ്റീസ് EMI അത് കംപ്ലീറ്റ് കഴിഞ്ഞു.
ഓക്കെ ഓക്കെ ഓക്കെ. Okay, sir. Very good morning, James John, sir. Very good morning, Biju, and very good morning all our dear participants. So, sir, in the IB, let's start. IB. So, we are commencing today international banking. That is the first module of bank financial management. So, as I am posting in your groups in the early morning time, the days are very near. The number of days are limited. We are already started countdown some time back. So prepare well, because next year, you know, it is not going to be a big difficult thing, but you have to allot more, find out more time and work more if you are pushing this CIB to next year. 2 more papers are being added, negative marking is coming, no issues at all. But you do not wait for that. This time itself, you can pass the examination. You allot entire time for the next 50 or that many days which are remaining for your examination. Yesterday also I attended an examination of IABF, that is Insolvency and Bankruptcy Court. So I have gone through that and I have prepared well, but still I could clear the examination. From that examination also I had passed a treasury 2 months back, that is certified treasury, before that certified foreign exchange, certified credit profession, all this. Why I am saying this, I'm just not telling that I have passed all these things, but before your examination, one day we will have a meeting. So this year they manage your time, and how can you answer to questions which you have 100% confidence about be used, but I don't think that that will still, if you know, if we can score 35 to 40 marks, then the remaining 10, 15 or 20 marks easily we can score if you plan your time, that is manage your time, and also attend to the questions which you don't know in a different manner. So that will be discussed later, how to write your examination or up your examination. Definitely it will be definitely beneficial for you to score additional 5 to 7 marks. So that we will wait for another 20-25 days, because we have to complete the topics first. So today international banking also some numerical problems will be there. You try to understand the concepts. Only this one chapter is there, numerical, this thing, first chapter only. Then after that, all these are theory, that is NRA account, correspondent banking, then a letter of credit, then export import, and also the rules and regulations laid down by RBI, FEDI, ECGC, and FEMA. So you should have an overall knowledge about what you are going to study, so that now you will you'll be well positioned to prepare well, because so you know which all are the topics to be covered, which all are the topics you have to understand well, and all these things. So you prepare a plan of action and attend the class regularly, listen to the class, and note down whatever sir is saying during the class time. Don't wait for the PPTs. PPTs are prepared by the faculties to help them to take the class. Two things are there. One is to manage the time, and also to see that all the topics are covered. This is not a tool for preparing for the candidates to the examination. This can be gone through because last minute very what you call again reading, this will be good, but don't depend too much on this PPTs alone. But we will be posting it early. But in addition to that, you have to read the book we have already provided, and also the lecture notes. These are some of the learning tips. The next all these days, maximum time you please allot for this preparation of the CIB only. Definitely you can pass the examination. So with these words, I welcome James John sir. He is a chief manager retired from Indian Overseas Bank, and he is a very senior faculty, taking classes for IB and Treasury for quite a long time for us. And also he will be taking his basically from having the mathematics background, so he will be helping you in the numericals, which will be there in the retail banking also. So that way again he may be taking classes for you other than this IB and Treasury also. So on behalf of all of you and my behalf and IB's behalf, I am not taking much of the time. Welcoming our sir. Now he is international bank. He is taking from abroad only. He's right now he's in Singapore. So the time zone difference, everything can be explained in a better manner in foreign exchange. Okay. Sir, welcome, sir.
Thank you,
now
thank you.
Thank you, sir. Thank you, sir.
Thank you, Mohan sir. hearty welcome to all the participants once again. And we'll start in a few minutes. With the, I would like to remind you this portion which most of you may not have an opportunity to work in your desk. That means in the branch atmosphere, you may not have a chance to work in these, at least some of you. The terms, the terminologies which we use, and the way in which the discussions are going on may be quite new to at least some of you. Therefore, you have to allot more time, be very systematic, and continuous learning. That is more important. Maybe very simple, appears to be very easy and simple to you. But after the session, you just recollect what are the things have been discussed. Then you go one by one. You may not be able to recollect the entire thing or the terminologies and what does it mean. And therefore, it requires a continuous learning. That means after the session, once the session is over, try to repeat or try to read the relevant topic from the material which has been provided by IBS or IIBF. So that's the best way you can utilize. Don't you look at the PPT alone may not suffice your requirement, because as you know, the questions are multiple choice question, and that means in the text every sentence can be framed as a question. So unless you read the text in depth with full knowledge, with full concentration, you may not be able to answer some of the questions. That is number one. And number two, as sir was telling, it's an elimination. Sometimes there are 4 options and you feel that, and all the 4 appears to be similar. And you may be confusing with 2 options, A or B or B or C. Then you have to look for the most appropriate one. That's what they say. You have to choose the most appropriate one. That will be the final answer. So unless the concepts are very clear, you may not be able to answer it correctly. So be very systematic. Don't miss any class. And even if, since this is an online class, I have no control on you, because if it's an offline class, I can have a look at the participants. It's not like that. Sometimes you may be attending to some other work, or you may be diverting your attention, and after some time you will come back to the session, and you may not be able to understand what I was discussing. So try to allot the intense learning and sensitive, and try to work hard. Yeah, minimum, I told you after the session, minimum you have to spend 4 to say 6 hours a day for a starter or for a beginner. And those who have some of the knowledge, they can prepare for 3 to 4 hours. But in any case, it's a continuous learning is required. You learn, you attend the session, and after that you just close it, and you turn, after a week you open the topic. The entire thing may be appearing new to you. Therefore, a continuous learning is required. Unless the topic is thorough, please go through it again and again. With this humble request, I'll go to the topic. We'll start with the basics of foreign exchange. So as nobody need to worry about, I'll be starting from the basics, from the scratch. So if you attend to the session very closely and very say carefully with the full attention, then I don't think you have any difficulty. But repetition sometimes may not be possible, because if I go on repeating, then I may not be able to finish off the relevant topic with the stipulated time. So be very attentive. We'll go to the topic. So this session, I'll discuss about the as an introduction, or what are the basic things which you should learn in foreign exchange. So first is, this is the course content. What is foreign exchange? Its definition. Then the market participants who are all participating in the forex market. And next is the characteristics of this market. What are the features? Then what are the factors affecting the foreign exchange rate? Then exchange rate mechanism. types of foreign exchange transaction, foreign exchange quotation, and forward rates. And if time permits, I'll discuss few MCQs. Again, see, more than 200 participants are there. So I have a humble request to all of you. Please keep Madhavi, your mic is in unmute position. I'll mute it. Please be disciplined. I request once again, you don't keep your mic in unmute position. Always keep in mute position. And I'll give a time for interaction. That time you can raise your doubt and immediately see that your mic is in mute position, because it will be wasting lot of people. One person, if he's unmuting, then the entire more than 200 candidates are there. The time is wasted for others, because what I'm going to talk may not be audible to others. So please be disciplined. Please bear with me. I'll tell you, you have a doubt, you can raise it. That time alone, please unmute. Otherwise, keep the mic in mute position. So first, we'll discuss about what is meant by foreign exchange. You can have two definitions for this. As per Section 2 of FEMA 1999, Foreign Exchange Management Act 1999. For foreign exchange refers to any document. It can be a deposit receipt. It can be a letter of credit. It can be a draft. It can be a check. It can be a currency note, an export bill or import bill, which is payable in any foreign currency. So a USD currency note is a foreign exchange. A Japanese yen traveler's check for 1,000 Japanese yen is foreign exchange. A deposit receipt in dollar, it's foreign exchange. An export bill for 1 lakh euro, it is foreign exchange. So any instrument which is payable in a foreign currency. So here you should have a thing. What is meant by a foreign currency and what is a domestic currency or home currency? A foreign currency means, as far as India is concerned, which is the currency in India, it is Indian rupee. We represent it in 3 letters. It's not RS, it is INR, because universally accepted notation for currency is in 3-letter word. So Indian rupee is the domestic currency in India, or we also call it is the home currency in India. So this is the currency in India. Similarly, if you look at America, the currency is US dollar. So USD is the home currency, or it is the domestic currency in US, and Indian rupee is a foreign currency for a US citizen. So every country has got a currency we call that is the legal tender in that country, or I can say that is the home currency, but that is the domestic currency. So any other currency other than the domestic currency is termed as a foreign currency. So as far as an Indian is concerned, Japanese yen is a foreign currency, Euro is a foreign currency, Chinese yuan is a foreign currency, Pakistani rupiah or Sri Lankan rupee, all these are foreign currencies. So this is one definition for foreign exchange. Second definition, sometimes the instrument may be payable in Indian rupee, means drawn in Indian rupee, but payable in foreign currency. A draft issued by, say, Bank of BBME Dubai, Bank of the British Bank of Middle East Dubai, they will be issuing a draft in Indian rupee, but that is payable in foreign currency because that is issued by Dubai Bank, payable in India. So that represents foreign exchange because they convert the currency of that country and issue a Indian rupee. So any instrument which is drawn in Indian rupee is also foreign exchange if it is payable outside India. Similarly, a draft or a traveler's check or a letter of credit or a bill of exchange, which is drawn by an institution abroad, just like I explained to you. Suppose a person is importing a computer from Japan, and the cost of computer is the 2 lakh Indian rupee. So that 2 lakh Indian rupee is the cost of the computer, but the Japanese seller who is selling this computer to the Indian person, they need the currency equivalent to Japanese yen. So 2 lakh Indian rupee equivalent to Japanese yen has to be paid. Therefore, even though the instrument is drawn in Indian rupee, it is payable in foreign currency. Okay, so that is called the foreign currency. Or in short, you can say that any instrument if it is payable outside India, which is, we can treat it as it is a foreign exchange. And the second definition is the process of converting one currency to another currency is foreign exchange. That means a traveler is coming to your branch. You are sitting at the counter. A European tourist is coming to you. He is having 100 euro currency note. He is giving to you, give me, you convert this and give me Indian rupee. Suppose one euro is 90 rupees, then you 100 euro you collect from the traveler and pay him the rupee equivalent. 100 into 90, say 9,000 rupees you give. So that process, converting euro into Indian rupee, is also foreign exchange. So the process of converting one currency to another currency is foreign exchange. Now, next is who are the participants in the market. The first participant in the forex market is the central bank of that country. As far as India is concerned, it is RBI, Reserve Bank of India. So Reserve Bank of India is playing an important role in the foreign exchange market. So how do they play? They are not directly buying or selling forex from the market, from the customers. But how do they manage? They have foreign exchange reserves with them. So with this reserve, they manage, because when there is a huge, say, violent volatility or movement in the exchange rate, then RBI will come at the rescue and they pump in. Suppose the value of dollar against Indian rupee is, say, shooting up. Say it is 78, 79. You have witnessed it in the recent past. Last week, it has touched even 81 rupees, isn't it? So in such situation, when the dollar is appreciating and Indian rupee is depreciating, that situation, and if there is a violent movement, RBI will pump in dollars from their reserve. And that way they regulate or they minimize the exchange fluctuation in the market in terms of Indian rupee. So that is the role played by central bank of a country. Next is the commercial bank. You are all representing, most of you are from commercial banks. So the commercial bank does two types of transaction. One, they do merchant transaction. So the commercial bank does two. One is merchant transaction. Next is proprietary trading. So what is merchant transaction? On behalf of the customer. A customer comes to you and he is giving foreign exchange. So you collect the foreign exchange from the customer and pay Indian rupee. That means you buy foreign currency and give Indian rupee. So that you are doing as a banker at the request of the customer. Similarly, another person is coming to you. I'm going to Europe for a tour. I need 1,000 euro. Give me 1,000 euro. So you collect Indian rupee and give him 1,000 euro. So that means you are selling forex to the customer. So these two transactions are done by the bank at the request of the customer. And we term such transaction as merchant transaction. So merchant transaction refers to the transaction, or you can say the buying and selling of foreign currency by a bank on behalf of its customers. At the request of the customer, a bank buys or sells forex. We call it merchant transaction. Second is proprietary trading or trading transaction. What is the difference between merchant transaction and trading transaction? In the case of trading transaction, it is done not at the request of the customer, but the bank on its own. For what purpose? The purpose is they does it with an objective of generating profit. Because as you know, now every bank, the management is more, they are giving more importance for the profitability aspect. Am I correct? Therefore, for each and every transaction, a banker or as a banker, they view it in the profitability angle. Therefore, we look at the transaction in such a way that if there is a possibility of making profit, the banker does buying and selling in the forex market. And such transactions are called proprietary trading or trading transaction. So how does it work? It works in this fashion. Suppose the banker, we call the person who is dealing in this forex transaction, we call them the dealer. Therefore, the dealer, he is looking at the market. the forex market. And the market, as you know, the price of a commodity fluctuates. Similarly, the value of the currency also moves up and down. So the dealer looks, when they begins the business on a particular day at say 9 o'clock, when they open the business and they look at the value. And if the dealer feels that there is a chance of moving up, the value of the currency is going up, for example, US dollar, after some time, the price will move up. So now currently the value of dollar is 79 and the dealer predicts that it may touch 80 after some time. After some time means after 1 hour or 2 hours, not 1 day, 2 days like that. So they think that the value will go up. So what the dealer will do at 10 o'clock or 11 o'clock, they buy in bulk 1 million or 10 million USD at 79, thinking that the price will move. So when it moves up to 80, they sell it off. So they purchased at 79, sold at 80. They get a rupee of profit of 1 rupee per dollar. If the transaction is for 1 million, they generate a profit of 1 million Indian rupee. So this transaction is called the proprietary transaction or trading transaction. So this is done by the bank, not at the request of the customer, but at its own, with the objective of generating profit. And always it may not be possible to generate profit. Sometimes it will end up in a loss also. That all depends upon the prediction or the guessing done by the dealer, because the dealer predict that the value will move up to 80, but after some time, suppose the value of dollar is collapsing from 79, it is coming to 78, then there is no other way. They have to sell it at 78, incurring a loss also. So always the prediction may not be correct, and it all depends on the experience and the efficiency of the dealer. If the dealer is very expert and he can correctly predict, it will end up in a profit. So the bank, as a commercial bank, there does two types of transaction, one at the request of the customer, another with an objective of generating profit. And the third participant is the investment bank, because these banks, even the commercial banks, are also transferring fund. But these banks, investment banks, they are specialized in this particular transaction. So for movement of funds for investment, means from India, suppose Reliance Industries or Tata Motors, they want to set up a factory in say Japan or in Germany or in South Africa. So what they will do, they will transfer the fund for investment. So that transfer of fund can be done through an investment bank. So these are the example: Axis Capital Limited, Barclays Bank PLC. So they are also playing actively in the market. Then the big corporates, multinational companies like Tata Motors, Adani Group, they are also participating. Then individuals also, there is no harm. Individual can participate, especially high net worth individuals and NRIs. They're also participating in the market. And not the least, the brokers, forex brokers are also participating in the market, because the transaction which comes under foreign exchange, it is done by one person is in India and the other person will be in another continent. He may be in America, he may be in Japan, he may be in Australia, or he may be in Africa. Therefore, connecting the two parties, sometimes it requires a middleman, a broker, and that person we call the forex broker. So here you have to remember one point: any person cannot act as a broker. If a person wanted to act as a forex broker, first he should get registered with FEDI, and the FEDI will issue a certificate, an accreditation, and the accredited brokers alone can function as a broker. And what they will do, they connect the two people and they get a commission on that particular transaction. So these are all the market participants. Next, we'll move on to the characteristics of this market. What are the characteristics, the features? The number one, it is a 24-hour market. That means this market never sleeps, because here the marketplace means it is the entire world, the entire globe. Therefore, at any point of time, when we are in fast sleep, some part of the country will be awake and they will be doing the transaction, because of the countries are located at different time zones. Therefore, this is a 24-hour market, round-the-clock market, because anytime, some part of the world, it will be actively doing the transaction. Number two, it is an OTC market. there is no specific location. Here the location is the entire globe. If you want to do a transaction with a Japanese citizen, then the marketplace is India and Japan. If you are doing a transaction with Sydney, a person residing in Sydney, the transaction between Australia and India. So this is an OTC market. There is no specific location. Unlike your grocery market or fruit market, there will be a specific place where you have to go in and to do the transaction, whether buying or selling. Here, it's not like that. The global village is the marketplace. That means you can sit at your office or at your house or at your factory or at your branch and do the transaction if you have a system connected to internet. So that's what we call it's OTC market, means over-the-counter market. Next is it's a global market with no barriers. So there is no boundary. Entire globe, the global village or the entire world is the marketplace. I already explained. Next, it is in a highly liquid market. What is the meaning of liquidity? Easy to convert to cash. Suppose you have a dollar or you have a euro or you have a GBP. In no time you can convert to Indian rupee. Unlike you have a flat or a landed property, it's not possible to dispose it of as quickly as you can encash a check or close a deposit receipt. Am I correct? Therefore, this forex market, it is highly liquid market. Liquidity is too much. In no time you can convert to cash, whatever your foreign currency asset. Then the amount of transaction putting through in this market is very huge. It is huge. That is capital and trade. Two flows are there. One is trade flows, another is capital. What is meant by capital? Funds moving out or coming in. In two ways it is, because an American or a Japanese person, if they wanted to set up an industry in India, then forex will come to India. Similarly, suppose Adani Group, they want to set up a factory in Africa, then the funds will go out. So inflow and outflow for what? Capital purpose. That means for investment. We call it capital flow. Next is trade flow. Trade flow means business related transaction. So here trade means similarly inflow and outflow of capital for investment. Trade also you can classify into two: inflow of foreign exchange and outflow of foreign exchange. So inflow is it is export. So export trade means you are selling your commodity or your product, your equipment from India to a foreign country. Suppose you are selling $1 lakh worth of goods to America. That means the buyer who is buying this particular product has to pay. Please. Vinod Kumar. Please mute. Every time say 1 minute is lost, you are the loser, because the time is a major constraint. So you see, in two ways the trade flows. One is export trade, and in export trade, foreign exchange comes to India. And next is import. And in import trade, foreign exchange goes out of India. Because in import, what comes to India? Goods comes to India, and its price goes out of India. Therefore, remember, export means we are getting foreign exchange, and import transaction means we have to pay foreign exchange. On export inflow and import trade, the flow is outflow. So here the volume is very huge. So can you just imagine how much will be the turnover in a day in the international market? It is latest guideline, it is 6,600 billion or 6.6 trillion US dollar. So it's a huge amount. 1 billion is 100 crore. Therefore, USD 6,600 billion, that is the total volume of transaction putting through in the entire globe in a day. So you can just imagine how much volume it is. This includes both all the transactions, whether it is capital or it is a trade transaction or it's a miscellaneous transaction. Entire thing, it comes to 6.6 trillion USD or its equivalent, or 6,600 billion USD or its equivalent. Next is the fluctuation. It's a highly fluctuation, huge fluctuation, because every 4 seconds the rate changes. That is the statistics says. From the previous past record, it says that every 4 seconds the rate changes. If you look at the dollar now, maybe 79 rupees. In 4 seconds, the value of dollar will be either 2 paise up or 5 paise down. It fluctuates. That is huge fluctuation. Every 4 seconds, the rate changes. And another important point is the settlement is affected by the time zone factor. What is meant by time zone factor? Different countries in the world are located at different time zone. For example, now in India, you see the time is 10 o'clock. So in India, the time is 10 o'clock. Now you look at the world clock. You familiarize with the world clock. Here it's India. Some of the nations in the world are ahead of us in time. So if 10 o'clock is the time in India, in Singapore, it is 12:30. That means it is 2.5 hours ahead of us. And Singapore or Hong Kong, it is 2.5 hours ahead. Then in Japan, it is 3.5 hours ahead of us. So that means if it is 12:30, there it will be 1:30. And remember, some of the countries, they adjust the clock from moving from summer to winter. So in that case, this 2.5 hours, Singapore, they doesn't do it, but other countries, most of the countries, they adjust the clock. So now it is, the difference is 3.5 hours. It can go up to even 4.5 hours also. So approximately, Japan is ahead of us by 3.5 hours to 4.5 hours. Now next is Sydney, or I can say Australia. There it is 5.5 hours. That means it will be 3:30. Understand? So in India, it is 10 o'clock, 12:30 in Singapore, or around 1:30 in Japan, and Australia between 2:30 to 3:30. So these are all the countries, important countries I'm discussing, because these are all the countries which play in the market actively: Japan, Singapore, Hong Kong, Australia. So these countries, this is the timing you should understand. Now coming to the other, there are certain countries, set of countries which are behind us. And the first is the Middle East countries. They are 1.5 hours behind us. See, for example, Dubai, Abu Dhabi and all. They are 1.5 hours. That means there it will be 8:30 in the morning. Then you can say Saudi Arabia or Kuwait or Qatar. They are 2.5 hours. So there the timing will be 7:30. You go to say UK or European country. They are between 3:30 to 4.5 hours, 3.5 hours to 4.5 hours behind us. So there it will be, if it is 4.5 hours, it will be 5:30 in the morning. Now, ultimately, US, there it is 9.5 hours to 10.5 hours behind us. That means if here it is 10, there it will be 11 o'clock at night. Okay, that means it is Saturday, 11 p.m. So almost we can say 9 to 10 hours or 9.5 hours to 10.5 hours behind us. So these are all the countries behind us. Europe or UK around 3.5 to 4.5 behind us. US 9.5 to 10.5 behind us. Saudi Arabia, Qatar 2.5 hours behind us. Middle East countries, that means UAE 1.5 hours behind us, and other countries see ahead of us. Because there can be a question on this. The question will be put like this: when Indian markets are about to close or Indian markets are about to begin, they will say, when Indian markets are about to begin, which is true? They will give few options. Singapore market already closed, or Japan market closed, or they are participating, European market working, like that they will. So then you should understand, Indian market is about to start the business means 9 o'clock or 10 o'clock in the morning. So at 9 or 10 o'clock in the morning, what is the time at other countries? You should have a clear idea. Then only you can answer such questions. So the world clock has to be very much familiarized. Now, the next is market affected by governmental policies and control. This is again an important thing. You must have noticed what happened in Sri Lanka in the recent past. You go back some 2 months back, where there were a lot of problems in Sri Lanka and the government was toppled. They don't have any foreign exchange reserve. They're not able to import. They're not able to pay the debt. And such situation will arise. So then the government will impose certain restrictions, certain policies. So the policies will be affected in foreign exchange transaction. So the government policies and controls will affect the foreign exchange market. So these are the characteristics. We'll move on to the factors affecting foreign exchange rate. So what is meant by foreign exchange rate? Foreign exchange rate means the value of a currency. For example, dollar is priced at say 80 rupees. That means $1 is equal to 80 rupees means this is the foreign exchange rate of dollar. So exchange rate of dollar is 80 rupee means $1 is equal to Indian rupee 80. Similarly, 1 euro is equal to 90 means the exchange rate of 1 euro is 90. 1 euro is equal to Indian rupee 90. And what are the factors affecting the value of currency? You can broadly classify it into three. One is the fundamental reasons or fundamental factors. Next is the technical factors. And third is the speculative factors. Now, in fundamental factors, there are 5-6 items. The first one is the balance of payment or BOP. What is meant by balance of payment? And how does it affect the value of a currency? Balance of payment refers to the aggregate, the difference between aggregate inflow and outflow of foreign exchange. So balance of payment refers to the total inflow and outflow of foreign exchange. For example, in a particular month, say in the month of say October, or say in the month of September, suppose the inflow is 100 USD, 100 million USD, and outflow is 80 million USD. So this is inflow, this is outflow. This is the aggregate. Aggregate means it includes the investment inflow and the trade inflow and miscellaneous remittance. What is miscellaneous remittance? Miscellaneous remittance comes to, or you can say for tourists, inflow and outflow. People are coming from foreign countries to India. So when a traveler from Japan is coming, he is bringing Japanese yen. A traveler from Singapore to India, he'll be bringing Singapore dollar. So we get foreign exchange. That is inflow. Similarly, from India, people are going outside. People are going to Europe, to USA, to African countries, to Australia, Canada, and all. Then forex is going out. So that is a tour, or you can say the travelers. Then next, education purpose. A lot of people from India are going out for studies. So forex is going out. Similarly, so many foreigners are coming to India for education. So for education, inflow as well as outflow is there. Then see medical, for treatment. So many people are coming to India for treatment. Similarly, from India also, wealthy people are there, they are going to US or UK for better treatment. So in that case also, forex is coming to India as well as going out. So the aggregate of the entire thing, suppose it is 100 million USD in the month of September, and that is the inflow, and the outflow is 80 million USD. So what is the balance? The balance is, you can say it is the 20 million USD. So this is known as the balance of payment. Okay. Pankaj Tripathi, do you have any doubt?
Sir, how this foreign exchange reserves is maintained with RBI? In which form?
They will be having in different forms. They will be keeping mostly in the form of say foreign currency asset. They will be having foreign currency asset with them. Say investment in various investment in say American dollar, in American so many ways they will be investing. So that's you see a liquid investment. So they in bonds and other securities, and those things they will be redeeming if they wanted to pump in dollars. Isn't it?
Sir, sir, suppose a student takes education loan in India for a study in USA or other country, foreign country. Then we provide DD of in Indian or what happened for actually when they have to pay in for USA.
You have to
Just
convert
like-
Indian rupee and give forex. Suppose a person is going to UK for study purpose. Suppose the tuition fee is coming to 10,000 GBP. His customer, his father or his parent or his relative comes to you. Give me 10,000 GBP. You have to pay 10,000 GBP and collect a rupee equivalent from the customer. So foreign exchange is going out.
Again, sir, suppose we disburse 20 lakhs loan for education purpose in foreign country. Then
Yes,
we loan is disbursed in Indian rupees, right?
No. Loan is disbursed in, see, you first what you will do, the procedure is like this. As an education loan, this is not relevant to the topic. Anyway, I'll explain 1 or 2 minutes. You should get a cost of study from the university. And the university says it is, say, 10,000 USD. Suppose is going to USA. So the cost of study, just I'm putting an example, 10,000 USD. And this is the total cost. Total cost. See, they will be giving some stipend or some scholarship or something like that. The net amount payable is 10,000 USD. So how you fix the loan amount? You look at what is the exchange rate at the time of sanctioning the loan. Suppose the value of dollar, then please mute. Then this 10,000 will be converted to Indian rupee. How much it is? It is 80 and 10,000 means 8 lakh rupees. Am I correct? 8 lakh rupees. 4 plus 5. 8 lakh rupees. So the loan amount you sanction is 8 lakh rupees. So the loan amount is 8 lakh, but the disbursement has to be done the payment has to be done in USD. Understand? So the forex will goes out. That is the rate you apply and convert the Indian rupee into dollar and remit the American university. That is the way you are doing. So here in your book, the customer has to pay in Indian rupee, but you have paid foreign currency. That means you are exchanging Indian rupee to dollar. That is what we are doing in foreign exchange. Got the point?
Sir, excuse me, sir. When it is pay in installment, it's suppose when $2,000 or USD, anything yearly, then USD rate will change next year. I suppose it
Yes.
will be 90 rupees. Then how can I disburse this amount? It will exceed 8 lakh rupees, na?
No. That way, see, when you cap an amount, you fix a loan amount. It will be restricted to that amount. Any difference amount due to variation in the exchange rate has to be borne by the borrower. They have to pay it.
Okay.
Understand? Okay.
Sir, balance of payment. Excuse me, sir. So balance of payment can be negative or positive. Like suppose the outflow is more.
Yes. It can be. That's what I'm coming to that. Coming to that point. So the balance of payment in this situation, I said that 100 million USD is the inflow, 80 million USD is the outflow. That means that particular country has got a comfortable zone because they have a surplus of 20 million USD. But it can be, so we can say that the balance of payment in that case, it is positive because inflow and outflow. Inflow is 100, outflow is 80. So there is a surplus of plus 20 million. Suppose inflow is 150 and outflow is 200 million, then there is a deficit of 50. That means the currency is becoming weaker. Understand? So this is what happened in Sri Lanka. They have less of inflow and more of outflow. So they're not able to meet the payment, the commitment. They have taken huge amount of loan from China and they're not able to make the payment because they don't have forex reserve with them. See, that's what every country, even take say the case of India, we have a forex reserve because this forex reserve is built up over a period of time. See, when it was 1947, when we got independent, our reserve was meager. It was, you can say, negligible. So we imposed a lot of restrictions. So subsequently, we concentrate on export. we done a lot of export. So many persons went outside and they employed. They send the remittance. So these are all the source of inflow of forex. So we build up our forex, and in that way, our forex reserve has been improved. And when the forex reserve is improved, we relax the things. That was happened. So from those things we will discuss in treasury management and later. So now we just understand what is balance of payment. Balance of payment is the aggregate difference between the aggregate inflow and outflow of forex. So how does it affect the foreign exchange rate? When the balance of payment is positive, the currency is stronger. Because look at this first case, we have a surplus of 20 million USD. So we don't bother. Our currency will be stronger. But you look at this case, we have only 150. We have to make a payment of 200 million USD. So there is a shortage of 50 million USD. So how this 50 million USD can be met? You have to buy forex from the market by paying Indian rupee. So they will say, okay, on dollar is ruling at 79. They will say, give me 80 rupees, then only I will pay. So because in any case you have to commit the full your promise. So you may have to buy at 80 or 81 rupees. So Indian rupee becomes cheaper. So that's what, when balance of payment is positive, the currency is stronger, or you can say it is the currency is in a well position, or it is appreciating. But when the balance of payment is negative, there is a deficit in the balance of payment. Just like you just imagine, say your income and expenditure in a month. Suppose your income is 1 lakh and your expenditure is 75,000. You are comfortable. Am I correct? But suppose in some month, because of hospitalization, some other purpose, your income is 1 lakh. You have to spend 1,25,000. So where to meet this 25,000 gap? You have to borrow from outside. You may have to borrow from the you can say from the money lender. So you'll be charging 3% interest. In any case, you have to meet. So you have to pay, you have to borrow at 3% or 5% per month. Am I correct? So same situation. When the balance of payment is in an adverse situation, the currency, the value of the currency comes down, or the currency depreciates. This point you remember. See, suppose the value of a dollar at one point of time, it is 80 rupees. And after $1 is equal to Indian rupee 80. And after some time, $1 is becoming 79 Indian rupee. So what is the, what happened to dollar and what happened to Indian rupee? One currency is appreciating, another currency is depreciating. In this situation, which currency is appreciating and which is depreciating?
Indian rupee is appreciating.
Yes. So in this case, currently $1 is 80 rupees. After some time, $1 is 79 Indian rupee, means Indian rupee is appreciating, or US dollar is depreciating. Second situation, currently $1 is 80 rupees. After some time, $1 is coming to 82 rupees. So what happened to Indian rupee? Indian rupee is depreciating. Indian rupee is becoming cheaper. Indian rupee is cheaper and dollar is costly on a future date. That concept you have to understand very clearly. So $1 now 80 rupees. After some time, if it is 82, means the value of Indian rupee is coming down, or the value of dollar in terms of Indian rupee is going up. Understand? So here at the balance of payment,
appreciation
and
depreciation. Bank of depends on balance of payment, sir.
Yes. See, the balance of payment, if balance of payment is positive, then the currency will be stronger, or the currency will be appreciating. If the balance of payment is negative, or there is a deficit, it means the value of the currency comes down, or it depreciates. The currency becomes weaker. Next is the economic growth. The economic growth rate. In a growing economy, they have to, a grown-up economy, see, a growing economy, that means they are growing in developing stage. So in a growing economy, import will be more. And when we go for more import, we have to pay for import. That means the currency becomes cheaper, isn't it? Because we need more forex for import. So when we go for more forex, we require Japanese yen if we want to import from Japan, or if we need more euro if we import from a European country, or we need more GBP if you are importing from UK. So in that case, we need foreign exchange. We require foreign exchange. Then the value of Indian rupee depreciates in a growing economy, and that is economic. So if in a growing economy, we have to resort to more import, and the currency will depreciate. Next is the fiscal policies. Fiscal policies and the monetary policy. What is fiscal policy? This is announced by the central government. Because we can say it is the government say expenditure, government taxation announcement. Generally, this will be announced in the budget. Every year, they will announce the income tax or other corporate tax decisions or government policies. If it is an expansionary budget, means they are more thrust they are giving for spending. So like that. So this fiscal policy also affect the value of exchange rate. For example, I'll give a very simple example. Suppose in the fiscal policy, in the budgetary announcement, a government reduces the corporate tax. Corporate tax, see, presently the corporate tax is 20%. They reduced this to 15%. So what is the impact if the corporate tax, means income tax rate of tax has been reduced from 20 to 15? What is the impact on Indian rupee? So if there is a reduction, the world economy, other people who wanted to invest in foreign country, they are looking at, and they come to know that in India, they have reduced the tax rate. That means the people, if they invest in India, from the profit, they need to pay only 15% instead of 20%. So a lot of investment will come to India. See, from UK, people will say that, see, there is a reduction in the tax in India, so why don't we invest? So people from UK, they will invest. They bring GBP, come to India for investment. So they will be bringing GBP and demanding for Indian rupee. So what is the end result? When there is a demand of a particular thing, more demand, its price will go up. So here, see, from Japan, people will come with Japanese yen because they want to invest here. So they will be bringing Japanese yen, they want Indian rupee. From UK, people will bring GBP, they want Indian rupee. So there is a demand for Indian rupee. So the value of Indian rupee appreciates. So when there is a reduction in the tax rate, the value of the currency appreciates. Understand? Next is the monetary policy. Who announces the monetary policy? This is the Reserve Bank of India.
Sir, fiscal policy did not get fiscal policy.
Policy means it is government, the central government is announcing the fiscal policy. Mostly it is the taxation policy, or you can say the government expenditure. So that they announce in the budget. So in the budget, see, an example is if there is a reduction in the tax, income tax, then the value of the currency appreciates. If there is an increase in income tax rate, the value will depreciate. Suppose from 20%, the corporate tax in the budget, they announced from 1st April onwards, the corporate tax is 30%. That means if a company is making 1 lakh as profit, instead of 20,000 rupees, they have to pay 30,000 rupees as tax. Therefore, people will not come forward for investing in India. So if nobody is coming to India, there is no demand for Indian rupee. That means when there is no demand for Indian rupee becomes cheaper. When there is a demand, it becomes costly. When there is no demand, it becomes cheaper. So monetary policy, again, monetary policy is something connected, or this is announced by Reserve Bank of India, depending upon the inflation rate. So here, the monetary policy, what are the things? The money supply. RBI is concentrating on the money supply. They will be fixing the interest rate, or they will say the repo rate, the cash reserve ratio, the SLR ratios. These are all the ratios which they control the money supply in the market. So monetary policy is also affecting the value of a currency. Next is the interest rate. Interest rate, how does it affect? Interest rate, suppose there is an increase in interest rate. When in the RBI announces the monetary policy, you must be remembering in the last review, I think last week, they have again hiked the repo rate. Repo rate, they have increased by 50 basis points. What is the impact of that? When the repo rate is increased by 50 basis points, 50 basis point means how much? How much percentage? 0.5%. So repo rate from 5.4, they have increased to 5.9. So what is the impact? Whether you have thought of, you are all going
Cost
to write
of money goes up.
cost of money goes up. Yes, because when the repo rate is hiked by 0.5%, and as you know, as per RBI direction, the banks has to link their advances to repo rate. So that means every advance, the interest rate is increased by 0.5% because it is repo plus 3%, repo plus 4%. That's what the bank is granting the loan because all floating advance is linked to repo. So if repo is increased, the interest rate of the loan is increased. When the interest rate of the loan is increased, the cost of money is increasing. That means the people will not come forward for taking loan, isn't it? Because it becomes costly. So it can control the inflation. So that is why if there is an interest rate in the increase in the interest rate, what happened to Indian rupee? Indian rupee, if there is an increase in interest rate, that means here it is increased. So automatically the loan interest will be increased or the deposit interest will be increased. Am I correct? So the average, suppose the average deposit interest for 1 year is 6%. Now banks are increasing this to 6.5%. So the international community, other people from the other countries, they are watching it. So currently India is offering for 1 year deposit 6%. They have hiked it to 6.5. So that means a lot of investors will bring in their foreign currency to India for investment because they can earn 0.5% more as per the revised guideline. So when there is an increase in interest rate, a lot of investors will bring in foreign exchange and they want to invest in India. So there is a demand for Indian rupee. And when there is a demand for Indian rupee, the value of Indian rupee appreciates. So reduction in increase in interest rate will appreciate the currency and the reduction in interest rate will depreciate the value of the currency. Clear? Because
when the rate is high, then the supply and consumption will be low, no?
Yes, yes. So this is
Then
a chain rule. That is a chain rule. See, when the interest rate is high, that means the production, the manufacturers or the entrepreneurs, they will not take huge amount of loan. When they don't take huge amount of loan, the employment generation will be less. And in such situation, money supply with the people will be less. So the purchasing power will reduce. And this will end up in reduction in inflation rate. That is what RBI thinks. Since the inflation is high, they have increased the interest rate to curtail the inflation. That is the thinking. Understand? So here, when the interest rate is increased, the value of Indian rupee appreciates because lot of demand for Indian rupee will come. For the foreign investors, they will bring in foreign exchange. So there is a demand for Indian rupee. And when there is a demand for Indian rupee, naturally the value of rupee becomes stronger.
Sir, but in today's situation in India, we are facing unemployment and inflation issue only. So you mean to say that we are going to curtain with bringing more money from foreign and will appreciate the money, then this problem will be resolved?
See, RBI is looking at it's a chain effect. There is a chain effect. RBI, the view of RBI is now the inflation rate is high. Inflation rate is high means the purchasing power or the value of rupee is less, isn't it? It is cheaper. That's what inflation is high. So when the inflation is high, what they will do? They want to reduce it. That means for that they increase the interest rate. Say they increase the repo rate. When the repo rate is increased, naturally the advance rate will increase. So advance rate increases means people will not come for loan. So the entrepreneurs or the manufacturing industry, they will not take much loan. So it affects the production, it affects the employment and employment generation. So the money with the public will be less. So then people will not go for more purchase, for more spending. So the inflation can be curtailed to some extent. That is the aim of RBI. But how far it will be successful, we can't predict. So this is the way. And here, this is another reason is it's a global scenario. Not only in India, this is happening in the world. Even in Singapore, I was talking to my son, there is a recession. In US, there is a recession because it's a global phenomenon now. Because of the recession, they are increasing the interest rate. That's all. So here, as far as foreign exchange rate is concerned, this is the impact. When the interest rate is increased, in the short run, I mean for say 1 year, lot of investment will come. So foreign exchange will flow to India. Therefore, there is a demand for Indian rupee. So Indian rupee becomes stronger, or Indian rupee becomes costly, or Indian rupee appreciates. But now the thing is, suppose $1 million has come to India and they are invested for 1 year. And after 1 year, when they take it back, that time, again, you have to pay it. So that time the value will come down. So that's a different thing. So immediately, if the interest rate is increased, the impact is the value of the currency increases. Okay, next is the political issues. How does it affect foreign exchange? Again, a firm government in a country, if the government is a firm government with absolute majority, and then the currency becomes stronger. And take the case of Sri Lanka. Sri Lanka or some other countries where a lot of terrorism activities or other civil disturbance is going on. The currency, nobody is willing to accept that currency. There will be no demand of that currency. So therefore, a stable government means lead to a stronger currency. The currency will be firm, or there is a demand. And if the government is not stable, there is no government. Sometime in Sri Lanka, there is no government. So in such a situation, the currency will depreciate. So these are all the important factors which affect the foreign exchange rate in the long run. So these are classified under fundamental factors or fundamental reasons. Next is the technical reason. Technical reason means the central bank of a country, they come in when there is a violent fluctuation in the exchange rate. The government or the central bank impose certain restrictions or certain control to stabilize the price. So that is classified as technical reasons. So government controls leading to violent movement of exchange rates. When there is a, you must be remembering the 78, 77, 78, 79, that was the range where dollar was fluctuating over a period, some 1 month back. Then it suddenly increased to 79, then 80, and it even touched 81. So such a situation means there is a violent movement. In the morning, begins at 8 o'clock, sorry, at 80 rupees. After, when it closes, it moves to 81. Means it's a violent movement. 5 paise, 10 paise increase means it is reasonable. So when there is a violent movement, what the central government will do, if they have surplus with them, they will pump in the surplus. The reserve, they will sell it in the market, and they will provide a supply of dollar so that to some extent you can stabilize the price. Next is the speculative factors. What is meant by speculation? Speculation means that there are speculators in the market. These people, see, take the case of an exporter. Exporter is doing a trade transaction. So he will be giving foreign exchange to you. Similarly, an importer is importing commodity or a machinery. So he will be requiring foreign exchange from you. So in these two cases, an exporter or an importer or a traveler or a student, they need the foreign exchange for that specific purpose. They require it. But speculators, they don't need forex. Even though they don't foreign exchange, they enter into a transaction. They buy foreign exchange in bulk, hold it for some time, and then they sell it when the price improves. So this is what the speculators does. So speculators, they doesn't require any foreign exchange, but they do the dealing, buying and selling, with an objective of generating profit. So these speculators are also playing an important role in the forex market. Okay. Next is different types of forex contracts. Foreign exchange transaction, you can classify into 4 categories. One is cash or ready, next is term, then spot, and forward. See, it's a very simple thing to understand. What is meant by a cash or ready transaction? When a transaction has been commenced on 30th September, see, this is a Friday, and on the same day, it has been completed. So the transaction commenced on 30th September and the same day it is commenced. Then we call it is a cash transaction or ready transaction. Understand? So that means the exchange of currency took place on the same day. There is a buyer and there is a seller, and the buyer gets the forex and the seller also gets the rupee equivalent. Then you can say that it is a cash transaction. So a transaction commenced on 30th September. It is a Friday. The same day it is completed. It is, or the exchange of currency takes place on the same day. We call it a date of settlement, or you can say the value date. We call it is a cash or ready transaction. But if the completion is taken place on the next working day, see here I have put 310. Why it is 310? Because international transaction or forex transaction is working from Monday to Friday. This is globally accepted methodology. Monday to Friday, it is full-fledged transaction. That means Saturdays and Sundays are treated as holidays. Okay, so TOM means next working day, completion on the next working day, or value date on the next working day. So if 30th is the date of contract, the 1st of October is Saturday, 2nd October is Sunday, and 3rd October is Monday, which is the next working day. So date of completion or settlement or exchange of currency took place on the 3rd of October. It is TOM. And remember, suppose 2nd October was not a Sunday, some other day, then it will be 4th October, because 2nd October is a holiday. Then 3rd October will come. And see, is it clear? I'll repeat once again. A transaction has been commenced on 39. Now, if it is completed on the same day, you can call it is a cash or ready transaction. Now, a transaction has been commenced on 39. And what is the next day? If it is completed on the next day, here, see, the next day is next working day in both the countries. That is more important. So 39 is the date of transaction. 110, this is Saturday, which is a holiday. Then 210, this is Sunday again, which is a holiday, and 310. So the next working day is 310. Therefore, 310, if it is completed, it is TOM. Understand? Then if it is completed on the 2nd working day, that means 410, we call it is port. And if the date of completion is beyond 2nd working day, that means either 410 or 510 or in November or December, we call it is a forward transaction. So somebody has raised some query. What is it? You can post it in the chat. Need clarification, appreciation, depreciation. 24 market, you told earlier. Appreciation, depreciation already explained. Appreciation, what is the meaning? Value is increased. Depreciation means value is decreased. That is what. So this is forex contract. So I repeat once again, forex contract you can classify into 4 categories. One is cash or ready. If it is completed on the same day or the exchange of currency takes place on the same day, we call it is a cash transaction or a ready transaction. If the exchange takes place on the next working day, it is TOM. On the 2nd working day, it is spot. Beyond 2nd working day, it is forward. Here you have to remember 2 things. Number 1, Saturdays and Sundays are treated as holidays. So remember, in India, even though the 1st Saturday and the 3rd Saturday are working day, as far as forex transactions is concerned, Saturday is treated as a non-bank day, even though it is a working day. For forex transaction, it is a holiday. And another important point, these are the 4 national holidays. That means one is October 10, next is August 15, next is 26th January, and 25th December. Because this is Gandhi Jayanti, this is Independence Day, this is Republic Day, and this is Christmas. These 4 holidays are already fixed, unless your Holi or your Diwali or some other festival, which are not fixed. So these dates are fixed. So in the examination, there will be a question and intervening will be any of the day. Suppose they will say 14th. A transaction has been commenced on 14th August and which is completed on 18th August. Then how to classify whether it is storm or sport? Then you have to treat 15th August as a holiday. And again, they will give, that's what here I have given Friday. 30th September is Friday. So this is an indication that next 2 days are holidays. So like that. Any doubt up to this point? You can expect a similar question on this topic also. We'll move on to the next one, exchange rates. There are the exchange rates, it's a two-way quote. It's a two-way quote means the rates are quoted in two ways. One is the buying rate, another is the selling rate. I'll repeat once again, buying rate and selling rate. What is buying rate? Buying rate is the rate at which bank buys a currency, and selling rate is the rate at which bank sells a currency. So you may have a confusion how to know whether it is a buying or selling. I'll explain it in detail, but before that, the term you familiarize, buying is also known as bid rate. Therefore, buying rate and bid rate one and the same thing. Coming to selling, it is also called offer rate or ask rate. So in the examination, they may sometimes use the word offer rate. So if it is offer rate is given, you should know it is nothing but selling rate. Offer rate or ask rate or selling rate is one and the same thing, and a bid rate and buying rate are one and the same thing. Now I'll explain how to know a transaction is buying or a transaction is selling. So here remember, this buying and selling is with respect to the bank. So the question will be put in such a way. You received a check, or you received an import bill, or you received a request. So what is you? You are not an individual. You are representing a bank. You means you are a bank, maybe PNB or Bank of Baroda or SBI. Therefore, you means you are a banker. So as far as a banker, if bank is buying, bank will apply the buying rate. If bank is selling forex, bank will apply the selling rate. I'll give a very simple example. Suppose you want to buy a laptop. You'll go to a shop. You are Mr. A. You go to a shop. You negotiate with the shop owner. Say B is the shop owner, and you fixes the price. And the shop owner says the price is 40,000 Indian rupee. So what you will do? If you want to buy a laptop, you pay 40,000 Indian rupee to B, and B in turn gives you a laptop. Isn't it? So what you got? You got a commodity. What you give? You give Indian rupee. So this is a buying transaction. So in a buying transaction, A gets a commodity, because here laptop is the commodity, and A gives Indian rupee. Am I correct? Now coming to B. So for A, this is a buying transaction. Now coming to B, what is B getting? B gets Indian rupee, and B gives a commodity. So for A, it is a buying transaction, and B, it is a selling transaction. Am I correct? So here, there is only one transaction. A give 40,000, A received a laptop. B received 40,000, given a laptop. For A, it is a buying transaction, and for B, it is a selling transaction. Is it clear? So here, in a buying transaction, I can generalize. In a buying transaction, A is receiving a commodity, and A is giving Indian rupee. In a selling transaction, B is giving a commodity and B is receiving Indian rupee. Is it clear? So same principle will apply in the case of forex transaction also. So you are a banker and there is a customer. So these two, the banker, there is a banker and there is a customer. Now here, Indian rupee is money and all foreign currency you treat it as a commodity. So that means USD is a commodity, Japanese yen is a commodity, Euro is a commodity, GBP is a commodity, all other foreign currency you treat as a commodity. Now I will put you a question. A traveler, he has got 100 USD currency note. So this traveler is coming to you. You are at the counter of your bank. This traveler is a foreign, say American. He is coming to you. He is giving you 100 USD currency note and requesting, give me Indian rupee.
7,990.
Please mute your mic. So here the traveler or the American is giving you dollar currency note, 100 USD currency note, and he is demanding Indian rupee. What is the transaction for you? You means your bank. Whether the bank is buying or bank is selling.
Buying.
Buying.
Please mute. Please mute. See, some of you said it is buying and some of you said it is selling. My question is, as far as the banker is concerned, because my question is on you. You means you are the banker. So in a buying transaction, you bring to your mind the laptop example. So in the laptop, you are buying a laptop. When you go for buying a laptop, whether you are getting Indian rupee or you are getting laptop, you are getting laptop. And what you are giving? You are giving Indian rupee. So in a buying transaction, you are getting a commodity and you are giving Indian rupee. Now here the situation is the customer or the tourist is giving 100 USD currency note. What is it? Is it Indian rupee or a commodity? It is a commodity. And this commodity you are receiving, you are getting the commodity. And what the traveler wanted, he wanted Indian rupee. So you have to pay Indian rupee. So you means the bank is receiving a commodity and the bank is giving Indian rupee. Now you tell me what is a transaction for the bank? Anybody say that it is a selling transaction?
Buying.
Transaction.
Very simple. When the bank gets forex, when bank gets foreign exchange or bank receive foreign exchange and the bank gives Indian rupee, it is a buying transaction. Clear? Coming to second situation. You have a customer. Say customer A. His son is studying in Singapore and he is coming to you. Give me Singapore dollar 1,000 to meet my son's education expense or living expense. So a customer is coming to you, give me 1,000 Singapore dollar and you debit the rupee from my account. Give me 1,000 Singapore dollar. So what is the transaction for the bank? Selling. Because bank is giving Singapore dollar and in turn bank is getting Indian rupee. So a buying and selling transaction, until you are thorough with the buying or a selling transaction, there is no point in proceeding further. So I have given some important tips. Number one, what is the buying rate? It is the rate at which bank buys foreign exchange. So that means when bank buys from the customer, what is for the customer? Customer is selling, isn't it? When the traveler is giving currency note to you, for the traveler, it is a selling transaction. but for you, it is a buying transaction. Or you can say bank receives foreign exchange and bank gives Indian rupee. Or you can say there is a credit in customer's account. So this is the very important tip to remember. If you are crediting customer's account, suppose customer wanted $, customer wanted $1 lakh. So you give $1 lakh to the customer and you credit to the customer, or you debit the rupee equivalent to the customer. When you give $, you have to debit. So in a so this you keep in mind. In a selling transaction, there will be a debit in the customer account, and in a buying transaction, customer account will be credited. That means the customer means the person who is giving you foreign exchange. When the person is giving you foreign exchange, you receive that foreign exchange and pay Indian rupee. If it is a traveler, he doesn't have an account, you pay Indian rupee. If he is a customer having an account with you, you credit his account. Therefore, remember, in a buying transaction, it is a credit. And here, what is the spread or the margin? Spread or margin means the difference between the buying rate and selling rate. Suppose you buy $, at say 79 rupees. Suppose you buy $, at say 79 rupees and you sell $, at 79.10. So this is the buying rate and this is the selling rate. So what is the margin? 10 paise. This 10 paise is your profit. You buy at 79, sell at 79. So selling rate. Next is exchange margin. In a buying transaction, you have to deduct the exchange margin, because suppose the rate is, the market rate of $, is 79 rupees. This is the market buying rate. Now you want to buy from the customer. You have to load 25 paise as your profit. So in the market buying rate, interbank market means the market where banks are doing buying and selling. So the market buying rate is 79. You want to buy from the customer. At the same time, you need a profit of 25 paise. So at what rate you will buy? Whether you will buy at 79.25 or you will buy at 78.75.
78.75.
Therefore, this is the point. In a buying transaction, the exchange margin has to be subtracted. An important point. Exchange margin you deduct. Suppose the 79 is the selling rate and you need a 25 paise as profit. At what rate you will sell?
Not clear, sir. Please repeat.
79.25.
You will sell at 79.25. Somebody was telling not clear. I'll repeat once
Sir,
again.
concept, yes, sir.
See, suppose the euro in the market, interbank market, 1 euro is 90 rupees. This is the buying rate in the market prevailing. And you need 10 paise per euro for putting through a transaction. A customer is giving you euro. At what rate you will buy? Whether you add this 10 paise and buy from the customer at 90.10 or you give only 89.90. This is my point.
89.90.
89.90. So that is the point. So here, in the case of a buying transaction, this exchange margin has to be deducted. That's what I have written. So merchant buying rate means customer buying rate is equal to spot buying less the exchange margin. Understand?
Sir, in short, buy at low, sell at high.
Buy low, sell high. Yes, that I am coming to that. I will come to that.
Yes, yes. Okay.
So now coming to the selling rate, just opposite, the rate at which bank sells. That means bank give foreign exchange and gets Indian rupee, or there is a debit in customer's account. Merchant transaction, you add the margin. Exchange margin, you add with the interbank selling rate. So remember this, only one point to remember. Exchange margin is to be deducted for a buying transaction and exchange margin is to be added for a selling transaction. Understand? If you want to quote a customer selling transaction, you have to add the exchange margin. For a buying transaction, you have to subtract the exchange margin. Next is how the currencies are quoted. There are two methods of quoting the value of a currency. One is called the direct quotation and the other is the indirect quotation. So one is direct quotation, another is indirect quotation. Again, direct quotation has got two more names, price quotation or home currency quotation. So direct quote or home currency quotation is one and the same thing, and indirect quote means foreign currency quotation, one and the same thing. And indirect quote, how it is quoted? Quotation you are familiar, no? Suppose you want to buy a bike, you go to the shop and ask for an invoice. That is called the quotation. So here how the rate is quoted. Normally the rate is quoted like this. See, USD INR 79, 10, 20. If the rate is quoted like this, so what does it mean? This means
Indirect.
1 USD is equal to Indian rupee 79.10, the buying rate, and 1 USD is equal to Indian rupee 79.20, the selling rate. So remember, 79.10.20 means the first rate is the buying rate, means the rate at which bank buys dollar from the customer, and the second rate means 79.20. It is not mere 20, it is 79.20. Sometimes the quotation will be like this. If it is 4 decimal, 79.1525 and say 50. So how does you expand this? This means first is 79.1525 and the second is 79.1550, because this 25 is replaced with 50. Okay. Normally it will be quoted in 4 decimal, and sometimes in the question they will be giving only 2 decimal. Doesn't matter if it is in 2 decimal, the third and fourth you can take it as 00. So generally it will be in 4 decimal. So the first is the buying rate, second is the selling rate. Fine. So if this is the rate, the quotation is like this. That means $1 is equal to so much Indian rupee. Or sometimes it will be €1 is equal to say 80, or 1 GBP is equal to 95. So like that the quotation, we call it is a direct quotation. So here what is fixed? See, $1, €1, 1 GBP. That means the foreign currency is fixed, and the home currency, here it is 79.10, here it is 80, here it is 95. That means the home currency is variable. So the foreign currency is fixed and home currency is variable. We call it is a direct quotation or price quotation or home currency quotation. Suppose instead of this, it is like this: 1 INR is equal to USD 0.015, or 1 INR is equal to GBP 0.005, like that. That means 1 Indian rupee. Always the domestic currency or home currency is fixed and the foreign currency is variable. We call it is a indirect quotation or foreign currency quotation. Okay. So here it is. In direct quote, the value of foreign currency is expressed in terms of various units of domestic currency. That means the foreign currency is fixed and domestic currency is variable. Example, 1 USD 79.50.58, or 1 euro. Or an example of Apple. 1 apple is equal to 20 rupees they buy, and for 25 rupees they sell. 1 apple they buy at 20 rupees and sell at 25. So here the principle is buy low, sell high. As any merchant does, they buy at a lower rate and sell at a higher rate. This is what a direct quotation. Always a question they used to ask from this also. And the relationship is, one is the reciprocal of the other. Now, indirect quotation, what is fixed? The domestic currency is fixed. For example, 1 Indian rupee is equal to so much dollar, or 1 Indian rupee is equal to so much euro. Or here, 100 Indian rupee per apple. That means for 100 rupee, 5 apple they buy and 4 apple they sell. Look at the two quotations. Both appears to be different, but it is giving you the same value. Am I correct? Because here the merchant says one apple, if you want, pay me 25 rupees, you can collect one apple. And if you want to sell apple to me, I will pay per apple 20 rupees. They buy at 20, they sell at 25. What does this say? For 100 rupees, I will buy 5 apple. You give me 5 apple, I will give you 100 rupees. If you want apple from me for 100 rupees, I will give you 4 apple. So both are same only, isn't it? 4 apple for 100 rupees means what is the cost per apple? 100 by 4, 25 rupees. But here the quotation they have expressed in a different fashion. That is what we call it is indirect quotation. So here buy low, sell high. Here see, this is the buying and this is selling. So buy high, sell low. Here the principle is buy high, sell low. So this also they use to us. Direct quotation, the principle is buy low, sell high. In indirect quote or foreign currency quotation, it is buy high, sell low. Okay. This already explained how the rate is quoted.
Sir, previous slide, please.
Sir, previous slide, sir.
Yes.
Sir, here indirect rate equals to 1 by direct rate.
Direct rate is 1 by indirect rate. The reversal of one is the relationship between direct rate and indirect rate. Because $1 is 79.50 means 1 Indian rupee. How do you take 1 Indian rupee is equal to 1 by 79.50? That is the buying rate. Similarly, 1 by 79.58, that will be the selling rate. But the thing is, you have to reciprocate it. That is another important point. We'll discuss it subsequently.
Okay.
Okay. Already I have explained this point, how we represent. Now we'll move on to the next important thing, rounding off.
So can we have a break?
You want a break? 11 o'clock. But some more points are there.
Sir, you finish this one, sir.
After this, I will give you a break. Okay. See, what FEDE says, what is FEDE? Foreign Exchange Dealers Association of India. What is their role? They are a SRO, self-regulatory organization, formed at the request of Reserve Bank of India. And all institutions, whether it is a bank or some other financial institution, they are engaged in foreign exchange transaction. They have to abide by the rules of FEDE and they have to get registered with FEDE. So they have to follow the FEDE guideline. Therefore, FEDE stipulate the broad guidelines on how the foreign exchange transaction can be put through. And one of the guidelines is the quoting the rate. The rate has to be quoted in 4 decimals. That is FEDE guideline. If the value of the currency is expressed in Indian rupee. Remember, if the value is expressed in Indian rupee, it has to be quoted in 4 decimal and the last 2 decimal. That means the 3rd and 4th decimal should be multiple of 25 or 50 or 75 or 00. So say symbol to understand, you can have say 00 somewhere here, 25, 50 and 75. Now look at, suppose on after solution, you attended a question and you got the rate as 72.5230. This rounding off has to be done as the last step for quoting the exchange rate. Now look at, you have arrived at this rate. Now look at the FEDE guidelines. FEDE guidelines says the 3rd and 4th decimal should be multiple of 25. Here the 3rd and 4th is 30. So this has to be rounded off. Just like we round off rupee, this 30 has to be replaced by any one of the 4 options. Now to which you round off? That is the important point. So what you have to do is look at 30, where it lies. 30 is between 25 and 50. Am I correct? Which is more than 25 and less than 50. Now next step, to which it is nearer, whether to 25 or to 50. 30 is somewhere here. This is nearer to 25. So you round off to 25. So 72.5225. Look at the second one, 80.9270. Now the 3rd and 4th is 70. You have to rewrite or you have to make it any of the 4. Now 70, where it lies? 70 is between this 50 and 75, somewhere here. So to where it is nearer, whether to 50 or to 75. This is 20. The difference between 50 is 20. Difference from 20 to 75, it is 5. So to where it is nearer, 75. So you round up to 9275. Look at the third, 7587. Again, 87 is between more than 75 and less than 00. So somewhere here 87. To where it is nearer, difference between 75, it is 12. With 00, it is 30. So nearer is 75. So round up to 75. Next, 7588. So 88 is somewhere here. To where it is nearer, whether to 75 or to 00. It is nearer to 00. So round off 75. This 5 becomes 6. So 7600. Next, 4545. 45. 45 lies between 25 and 50. 45 is somewhere here. And to where it is nearer, to 50. Therefore, you can round off to 4550. Any doubt? Rounding off? Because
No, sir.
here two
Sir,
things.
fourth one, sir.
Pardon?
Fourth one, please explain, sir, once again.
71.4545. So
No,
the
fourth.
decimal, third and
Fourth
fourth,
one.
which one?
Fourth
This one. This one.
Yes, sir. 588.
7588. Now
Yes,
this
sir.
88 is between 75 and 00. Am I correct?
Yes, sir. Exactly.
More than 75 and less than 800. Now to which is nearer? To 75, what is the difference? To 75, the difference is 13.
13.
And to 00, the difference is 12.
That also 13 only.
How?
Okay.
12. So which is nearer? To 00.
0. Okay.
So you round off to the next number.
Last one, sir.
Last one, 45. So 45 is lying between 45 lying between 25 and 50. Am I correct? More than 25, less than 50. So which it is nearer? From 25, the difference is 20. From 50, the difference is 5. So you have to round off to 50. To the nearest number you have to round.
Okay, sir. Okay, sir. Please.
So shall we break? Okay, when you can assemble? 11:30. Okay, 11:30. 11:30. Pardon? 11:45.
No, 11:30.
11:30.
Sir,
11:40.
11:40, sir.
11:40. Okay, 11:40. Then you have to sit late because otherwise I may not be able to finish off.
Sure, sir.
11:30. Sir, we will take 11:30. We will join on 11:30.
11:30 enough, sir.
11:30 we
Sir,
will.
11:30 we join, sir.
11:30, sir.
Okay, 11:30. 20 minutes break. 20 minutes break. Join. Oh, fine. Yes, welcome back. Shall we start?
Yes, sir.
Yes, sir.
We'll move on to the forward rates. So what is forward rate? Forward rate is a rate which has been settled after 2 days of commencement of the transaction. Or you can say that it is nothing but a future day rate. So forward rate refers to a transaction which has to be put through on a later date. Understand? And the forward rate, when we compare with the spot rate, it can be sometimes more than the spot rate, sometimes it is less than the spot rate. I will give an example. See, suppose the spot rate of a particular currency, dollar, is like this. USD INR is 79.405075, and 1 month forward rate is 79. Say 5080 90. So that means the USD in terms of Indian rupee as of today is 79.4050 and 75. So the first is the buying rate and second is the selling rate. Now 1 month forward, that means if the transaction is happening after a month, the value of dollar, bank will buy at 79.5080 and bank will sell at 79.5090. That means on a future date, the dollar is costly. Here, see 4 decimal. To understand more clearly, suppose GBP INR is say 88.5060. This is spot. And 1 month is 89.70 and say 85. So if this is the quote, so here the spot rate of GBP is 88.50 and 1 month forward it is 89.70. So what does this indicate? The value of dollar on a future value of GBP on a future date is more, or you can say it is costly, or this is how much it is more. This is the difference is 1 rupee 20 paise. So this is more by 1 rupee 20 paise. So or I can say that GBP is costly on a future date, or I'll say GBP is at a premium. So when do we say a currency is at a premium? If the future value or the forward rate is more than the spot rate, we call it is at a premium. Suppose this is the spot rate and 1 month forward is 88.1015. Suppose this is the situation. So here the spot is buying is 8850 and 1 month forward it is 8810. That means the value of GBP has reduced, or the value is decreasing, or I can say it is at a discount. Similarly, the selling also 8860 is the spot rate, but 8815 is the 1 month forward selling rate, which is lesser than the spot rate. Therefore, when you say that a currency is at a premium, if the future value is more than the spot, we say that the currency is at a premium. And if the future value is less than the spot, we will say that the currency is at a discount. Okay. Now, sometimes they will give you the spot rate. Suppose the spot rate is, question will be like this: spot rate USD INR 78.5060, and 1 month forward they will say points 20-30 paise, and 2 month forward 45-50 paise. Like that, a question will be given. So here, when the forward points are given, you have to look at the forward points. Sometimes in the question, they will say dollar is at a premium or dollar is at a discount. If the word premium indicates that the future value is more than the spot value. If it is discount, that means the future value is less than the spot value. That is premium and discount. In some cases, they will not give you, or they will not mention the word premium or discount. Instead, what they will say, they will just say forward points. So in such case, you look at the forward points. Here it is 20-30. And here the first forward point is for buying transaction. And second forward points is for selling transaction. That is understood. Similarly, just like this is the buying rate and this is the selling rate. And similarly, this is the buying forward points and this is the selling forward points. Number 1. Number 2, look at the two forward, the buying and selling. If it is in the ascending order, ascending order means it is in the increasing 20-30. 20 and 30 is more than 20. That means this is in the ascending order. So If the forward points are in ascending order, that means the currency is at a premium. Similarly, now second situation. Suppose 1 month forward is 25.20 paise. Suppose this is the given, spot is given, 1 month forward is 25 paise, 20 paise. That means buying points is 20 paise and selling points is 20 paise. So this is 25 paise, this is 20 paise. So that means the selling points is less than the buying points. Here, the selling points is more than the buying points. That means ascending. Here, you can say the forward points are in descending. If the forward points are in descending, then you should understand that the currency is at a discount. I'll repeat once again. Looking at the forward points, you can decide whether the currency is at a premium or discount. When the forward points are in ascending order, the currency is at a premium. And if the forward points are in the descending order, the currency is at a discount. So 1 month forward, 25.20, or 2 month forward, say 40.35 paise. So here also it is descending. Understand? So look at the forward points. Whether it is ascending, see that it is at a premium. If it is descending, it is at a discount. Now, you want 1 month forward buying rate. Suppose you want 1 month forward buying rate and selling rate. So if you want 1 month forward buying rate, what you have to take? You take the spot buying rate. What is the spot buying rate? Is 78.50. So take 78.50. Then look at 1 month forward points, 20.30, ascending premium. And what is buying premium? 20 paise. So you write 20 paise and add, because currency is at a premium. So you will get 78.70. Similarly, if you want 1 month forward selling rate, you take the spot selling. What is the spot selling? Spot selling is 78.60. Now look at 1 month forward selling points. 1 month forward selling points is 30 paise. So write 0.30. Since currency is at a premium, you add. You will get 78.90. So this is the way in which the forward rate is arrived at. So how to get the forward rate? Look at the spot rate. Then look at the forward points. If the forward points are in ascending order, currency is at a premium. That means you have to add the forward points to the spot rate. To get the forward buying rate, take the spot buying rate, add the forward buying points. To get the 1 month forward selling rate, take the spot selling rate, add 1 month forward selling points. You'll get. Similarly, if you want 2 month, what you have to do? Suppose you want 2 month, then 2 month spot buy. What is spot buying? Spot buying and selling. So buying rate is 78.50. Then 2 month forward buying points 45. Right, 45. Add it, you will get 78.95. Similarly, if you want 2 month forward selling rate, take spot selling rate, which is 78.60. Then 2 month forward points 50. Right, 50. Add it, you will get 79.10. Now look at the second situation. Here, currency is at a discount. When the currency is at a discount, how to get the buying rate and selling rate? If you want the buying rate, now take 1 month. Take the spot rate. What is the spot rate? Spot buying 78.50. 1 month forward buying points 25. Now this is descending. That means currency is at a discount. So you have to subtract. You will get 78.25. If you want selling rate, take the spot selling rate, which is 78.60. Then take the selling points. 1 month forward selling points is 20. So write 0.2. You subtract, you will get 78.40. Like that, you can calculate for 2 months also. Is it clear? It's a very simple concept. If you are asked to calculate the forward rate from the spot rate, you have to, if the currency is at a premium, add it. If the currency is at a discount, you have to subtract the forward points. How to decide whether the currency is at a premium or discount? If the forward points are in ascending, currency is at a premium, then you add. If the currency is at a descending order, then it is at a forward points and descending order, currency is at a discount, you have to subtract. So forward rate is nothing but the future rate, and the forward rate is a function of 3 things. Number 1, the spot rate. Number 2, the forward period. And number 3, the interest rate differential of the 2 currencies. So remember, the forward rate means the future rate depends on 3 factors or 3 things. One is what is the current rate, or we say the spot rate. Next is the forward period. This forward period will be either they will say 10 days, or they will say 30 days, or they will say 2 months. Forward period of 2 months means the transaction will be conducted or undertaken after 2 months. If it is 30 days means it is done after the delivery will take place after 30 days. So that is the forward period. And what is the interest rate differential? Interest rate differential means, suppose you want the USD INR forward rate. Then the 2 currencies are, one is USD, another is INR. This currency is called the base currency, and this currency is called the quoting currency. So remember, if the quote is USD INR, USD is known as the base currency and INR is the quoting currency. If the quote is GBP SGD, so this is the base currency and this is the quoting currency. So here, again coming to this one, USD INR. Suppose we want the forward rate of USD INR and the forward period is say 30 days. Then what you have to do? What is the interest rate in USA for a 30 days deposit? Average. It will be say 1.5%. And then in next currency is India. In India, what is the interest rate for a 30 days deposit? Say it is 4%. And what is the differential between these two? Means 2.50. So this is what the interest rate differential of the 2 currency. If the quote is between GBP and Singapore dollar, then and the forward period is say 3 months. In UK, average interest rate for 3-month deposit, say 2.8%. And in Singapore, the average interest for 3-month deposit, say 1.2. What is the difference between these two, which is 1.6? Am I clear? So interest rate differential of the 2 currency means what are the currency for which you are looking for the forward rate. The interest rate differential means the difference in the interest rate between the 2 currencies for the corresponding period. If the forward period is 4 months, interest for 4 months you are looking to. If the forward period is 45 days, you look for the interest for 45 days in the 2 countries. And there is a formula which you have studied in your JIB. At least some of you must be remembering it. And what is the formula? The formula is forward points, and you not write, it is here. Spot rate into interest rate differential into forward period in days divided by 360 into 100. Or it is spot rate into interest rate differential into forward period in months divided by 12 into 100. So remember, if the forward period is in number of days, the denominator will be 360. And if the forward period is in months, 1 month, 2 months, 6 months, then the denominator will be replaced with 12. And another important point, if there is no control on capital flows, that means in the case of developed countries, say Japan or Germany or UK or US, where they are all developed countries and there is no restriction in movement of currency. That means for inflow or outflow, there is no restriction. In such case, the major factor or the dominant factor in deciding the forward rate or forward point is the interest rate differential. Whereas if the currency is not fully convertible, then it also depends on the demand and supply. Okay. Next, already I explained the premium and discount. So forward rate is equal to spot plus premium. So from that, the spot rate is derived by subtracting premium from the forward rate. Similarly, already Parul, what is Parul Divedi? What's your doubt? Similarly, discount already explained. This already I have explained. I'll once again I will clarify your doubt. See,
Sir, the previous slide,
please.
Sir, previous slide, sir.
Forward rate.
Discount and premium.
1 second. Forward rate is equal to spot rate plus premium. Is it clear? Forward rate is equal to spot rate plus premium. So from this equation, what is spot rate? Sometimes they will give you the forward rate and the premium and ask to calculate the spot rate. How to get spot rate from this? From this formula, what will be spot rate?
Forward rate minus premium.
Minus premium. That's what one formula. Next is, this is the case when the currency is at a premium. Second, forward rate is equal to spot rate minus discount when the currency is at a discount. From this formula, what is spot rate? Forward rate
Plus discount.
Yes. So this you remember. So this formula says, if you have given the spot rate and the premium, to get the forward rate, add the premium. If you are given the forward rate and the premium, and you want
Sir, about that, when you were telling that in the the developed countries, if that slide, sir, we wanted to see. Sir.
That slide means, you see, it is this one. In the case of a country, these are the two notes. There is no control on capital flows. Just example, US or UK or America, Europe, those countries. See, where there is no restriction, means if the currency is freely convertible. That's what we call there is no control. Any amount can be taken in and any amount of forex can be taken out. Unlike India, we have restrictions. Our currency is not fully convertible. Our currency is partially convertible. That's why there are certain restrictions for movement of funds from India to foreign country or from foreign country to India. Understand? So if there is no restriction, that means freely convertible or fully convertible. In such cases, the forward rate depends on the interest rate differential alone. Whereas in the case of a country like us, where the currency is not fully convertible, then apart from the interest rate differential, it also depends on the future rate, or the forward points also depend on the demand and supply. That is the point I would like to.
Partly convertible means in what is that, sir? Can you please?
Convertibility. Again, convertibility that is there in your treasury. I will be discussing. Convertibility means you can have a forex transaction into two. One is a current account, another is a capital account. So convertibility means there is a fully convertible. There is no restriction. Any amount that is the fully convertible or freely convertible. As far as India is concerned, our current account is almost, we can say, fully convertible, and capital account is partially convertible. Therefore, Indian rupee put together, it is partially convertible. That means RBI, for certain types of transaction, you have to obtain a permission from RBI. For certain types of transaction, it is freely allowed, but for certain types of transaction, as per FEMA, we have to seek a permission from RBI, and after getting approval only, you can do either outward remittance or inward remittance. That is what fully freely convertible and partially convertible. Okay, so freely convertible means no restriction. So almost all developed nations like say America, Japan or Germany or France, UK, these countries, they are developed nations and there the currency is fully convertible. Means no restriction. The government puts no restriction. Any amount can be taken in and any amount can be taken out. Whereas India, we are in the developing stage, so our currency is not fully convertible, it is partially convertible. Now, another important point is this I have written at the bottom.
Interest rate difference I could not get, sir.
Pardon?
Interest rate difference, sir.
What is the problem? If you want the currency of, say, you want the forward rate of Canadian dollar and Australian dollar. And suppose you want the rate of 2 month. So in Canada, what is 2 month rate? 1.8%. And in Australia, what is 2 month rate? Say 1.4. So what is interest rate differential? 0.4%. This is interest rate differential. Okay. A difference in interest rate for the corresponding period in the two countries.
This is Canadian dollar is on the premium.
So in this case, in this case, which currency is carrying higher interest? Canada. So this currency will be always at a discount and this currency will be premium. That's what I have written. The currency carrying higher interest will be at a discount on forward. That is why Indian rupee is at a discount with most of the currencies on forward, because India, the interest rate is much higher than most of the other countries, the developed countries. In Singapore, it is 1.2 for say 30 days or 1 year deposit, where in India we pay 6%. So where the higher interest? In India. So Indian rupee will be always at a discount with respect to Singapore. That's what this point. The currency carrying higher interest will be always at a discount, or you can say the currency carrying lower interest will be always at a premium. Both are on the same thing. Okay. This already I have explained what is premium. Premium means currency is costly on a future date. To get that, you have to add the premium. And if you want the spot rate, you have to subtract the premium from the forward rate. So this is say 79.50, 60 is the spot rate. 1 month forward 5.10 paise. So how to get 1 month forward rate? Look at the 5.10 is in the ascending order. Currency is at a premium. You add so 79.50 plus 5 paise, 79.55. Similarly, 79.60 plus 10 paise, 79.70. For when forward points ascending order. So spot to term and spot to cash, you have to deduct. Then next is forward rate. If the currency is at a discount, means future values less than the current value, or you can say the future value of the currency is cheaper. That means you have to discount, you have to subtract the discount. Or if you are given the forward rate to get the spot rate, add the discount. Example, GBP INR 8910, forward points 10.5 paise. So here, see, this is in the descending order, 10.5. So 8.9.10, you have to subtract 10 paise. The buying rate is 8.9. Similarly, 7.15. This is very clear. This is again an example to understand the concepts. Look at it is given the spot rate 79, 40, 50. That means this is the buying rate, this is the selling rate. And the forward points 10, 12 paise, 25, 28 paise, 40, 45 paise. So looking at the forward points, you can decide, since it is ascending order, currency is at a premium. So if you want 1 month buying rate, take the spot buying 79.40. 1 month forward points 10 paise, add it 79.50. Similarly, if you want 1 month forward selling rate, take spot selling 79.50. 1 month forward selling 12 paise, add it 79.62. Similarly, for 2 month and 3 month, you can arrive. Similarly, next slide. Here, look. Euro USD, it is given forward points 20, 18, 35, 33, 60, 55. Now you look at the forward points. Here, the forward points are decreasing. 2018. 18 is less than 20. Similarly, 33 is less than 35. That means this is the currency. Euro is at a discount. Understand? So if you want the forward rate, you take the spot buying 1.2450. Now here, unlike in the previous,
it is increasing now, sir. Third month.
60.55. Is it increasing? 60.55. You have to not look at this. You have to look at this too. Buying and selling. 60.55. 60 is more, 55 less. That means it is decreasing. Means it is descending. Descending means the currency is at a discount. When the currency is at a discount, you have to subtract. Another important point. See here, the forward points alone given. They have not given the unit of the previous case. I have given you 10 paise. If you look at the previous example, look, here it is 10 12 paise. So 10 paise means when you convert to rupee, it is 0.10. So that's what we have written it 10. Instead of 10 12 paise, suppose the forward points is given as 10 12 without units. Without units. Remember, if it is 10 12, that means this 10 means it is 0.0010 and 12 means it is 001. Since here paise is given, you have to write it as 0.1 because 10 paise is 0.1 rupee. 12 paise means 0.12 rupee. That point to remember. Here it is, they have not given the unit of the currency. It is 2018. So if it is 2018 means you have to convert to 4 decimal. So 0.0020 and you subtract. Similarly, 18 means 0.0018. Subtract. Similarly, for 2 months and 3 months you can calculate.
Sir, previous slide, please. Previous slide, please. Okay. Okay, sir. Thank you.
Sir, here there is no round off, sir.
Here, now finally you can round off. Here, see what I have done is how to get the rate. For finally when you apply, when you go for the final step, here no round off. Here no round off. Why? Because the currency is Euro and USD. There is no INR. But in the previous case, there is INR is there. But here it is rounded off. Because only 2 decimal. The third and fourth is zeros. You're already rounded off. Okay. Here I told you, see, RBI FDI guideline is if the value of a currency is in Indian rupee, then only you need to round off. Here it is in euro in terms of USD, so no round off. Look at a question. A forward, to understand this forward rate concept, here is a question. A forward contract for USD 1 million was booked on 4th May. For the payment of an export bill. So here it is an export bill. So an export bill means for a banker, what is a transaction? Export means buying or selling.
Buying.
Therefore, we have to apply the buying rate, no confusion. Now, USD INR rate is given. So from this, you can write the buying rate. What is the buying rate?
79.6030.
First one, 79.6030. Now here the forward points are given. July 2.4, it is 2.4 paise. It is given 5 paise. August 4.5 paise. September 8.10 paise. October 12.17 paise. November 15.20 paise. So can you tell me whether dollar is in premium or discount?
Premium.
Premium, sir.
Premium.
So the currency is at a premium. Now the first question is, suppose the due date of the transaction or the delivery date is 15th August. That is what bill due on 15th August. When a bill is due on 15th August, you have to give the premium to the customer up to 15th August. Okay, so you take the spot rate, now add the premium. Premium, July 2 paise, August 4 paise, September 8 paise. See, when the forward points are given like this August forward points include the July also. Similarly, the September is including the July October means it is including July, August, and September. Or in short, it is cumulative. Got it? So if that is the case, suppose August is, we will restrict our discussion to the buying purchase. So August, the point is 4 paise. And September is 8 paise. So can you tell me, so this is up to August, this is up to September. So can you tell me how much is for the month of September?
4.
12 paise.
4 paise.
Similarly, suppose here again given September is 8 paise or July is 2 paise. July is 2 paise and August is 4 paise. That means this is up to July, this is up to August. So for August, how much?
2 paise.
Up to July,
2 paise.
Yes. So for August is 2 paise. Now we want up to 15th August. That means you can pass on the premium only proportionately. You cannot pass on the premium full month of August. Understand? Because the due date is 15th. So how to get 15th up, the premium up to 15th August? For that, to take the July premium. What is the July premium?
4 paise.
No. July is 2 paise. 2 plus half of August. Full month August, 2 paise.
Divided by 2 paise.
1 paise. So 15th August, it is 3 paise. 3 paise is the premium. Is it clear?
No.
Once again, explain.
Why 3 paise, sir?
Not clear.
Half of
Not
August
clear.
4 by 8 equals to 2 now.
Half of.
Please explain again, sir.
See, here the July premium, we will restrict to the buying premium. Okay, what is the buying premium for July? Look at here. What is the buying premium for July?
2 paise.
2 paise. So this 2 paise means up to July. Okay, and buying premium up to August 4 paise. So from this, what is for the month of August? Up to July 2 paise, to August 4 paise. So for the month of August 2 paise. This 2 paise is for the full month. So up to 15th means half. Half of 2 paise. So July.
August month 4 is there, no, sir?
Pardon?
For August month 4 is there, no, sir? They have mentioned clearly.
They have mentioned clearly
July 2
4 paise is cumulative. That 4 paise includes the premium of July also. It is not for the month of August. This August premium 4 paise indicates it is the premium up to August.
Okay.
Similarly, September 8-10 means it is the premium up to September. Understand?
Yes, sir. Yes, sir.
So you have to add a 2 plus 1, 3 paise. So take this.
Sir, if a question will be bill is due on 10th August, then we have to divide 2 divided by 3. In
Not
that
2
way,
divided by
we
3.
will calculate.
No, 2 paise is for how many days? 30 days.
30 days.
You calculate for 10 days.
Okay.
Yes, sir.
Yes, 2 by 3, like that. Suppose you want a 7 days. Then 2 paise for full month. Then for 7 days, 2 by 30 into 7. So you calculate for 1 day, then calculate for the required number of days.
Okay, sir. Okay, sir.
So here 3
But
paise.
in August it is 31 days, no, sir? We have to take 30 only.
Okay, you can do it 31 also. 31 also you can do it. So 2 by 31.
How export bill is considered as bill BR?
Buying rates. Export bill, what is happening in export transaction? Whether the bank is getting forex or the bank is giving forex. What is happening in export?
Getting forex.
Export means goods goes out of India and we are getting forex. So the exporter is bringing forex to you. So the banker is getting forex. When bank receive forex and give Indian rupee, what is the transaction? It is buying. So you have to apply the buying rate.
Okay.
So now you load the 3 paise. 3 paise when you convert to rupee, it is 0.3. Am I correct? So,
Sir,
39 point.
sir, you are adding 1 plus 1, 2 plus 1. So 1 means for you're taking one for month of August, 15th August only.
August 15 days. August 15 days. This is up to July. And August 1 to August 15, half of it. That is one
Okay,
place.
got it.
Okay. Next question is bill due on 30th September. So there is no confusion. You can take September because full month September.
Sir,
So what is the bill?
Sir, one doubt, sir.
sir, which decimal we have to add? On fourth decimal?
Sir, decimal,
Buying rate,
sir.
Third
buying
decimal.
rate 79.6030. What's the doubt?
Yes. Sir, then we have to add it on 0.0030 or something like that, no, sir.
Yes, sir. In last time you said that if it is paisa, it will be 0.00.
Here the unit is given in paise. That's what you are hearing, only half, not full. Here the forward points is given in paise. So paise you convert to rupee. 5 paise, how many rupee? 5 paise or 4 paise, how many rupee?
0.05.
Is it 0.0003 rupees or it is 0.03 rupee? 3 paise. 3 paise. 0.03, isn't it? Yes.
Yeah, it
So
is.
next, B, bill due in September. So you take the spot.
Sir, if
buying
it is
rate.
points, then we'll have to apply 0.00 like
Yes,
that.
if it is in points without the currency unit, if the paisa is not there, only 4, 5, 8, 10, then it is 0003. Okay, so buying rate 79.6030. This is the spot rate. I am answering the second question, B, 30th September. So look for September. How much it is? 8 paise. So 08. Add it.
79.683.
Next step, you can round off 79.6825. Similarly, the first question also you have to round off. First question also you have to round off. 15th August. That means you have to add 3 paise. There it is 79.6030.03. 79.6330. Then you round off. This is 79.63.
Sir, why not 0.0008?
Pardon?
Why not 0.0008?
Just explained. I just explained. You're not listening it closely. I told you when the forward points are 8, 10, then it is 0.0008. But if it is forward points 8, 10 paise, that means the buying points is 8 paise. 8 paise, when you convert to rupee, it is 0.08. If this paise is not given, only forward points 8, 10, then you have to write in 4 decimal.
Sir, you have previously shared the screen of a round pie chart diagram rounding up, no, sir? 25, 50, 75. Please once draw the diagram, sir.
Want to draw diagram once again?
Sir, just once, sir.
It's a very simple concept. See 0, 0. You remember the clock. Here it is 25. Here it is 50, and here it is 75. Now the third and fourth decimal is 30. Where this 30 lies? Between 25 and 50. To where it is nearer? Look for that. Is it nearer to 50 or it is nearer to 25? If it is nearer to 25, you round up to 25. If it is nearer to 50, round up to 50. That is the concept. Okay.
Okay.
Now look at the third question. Bill due in October. Here, these two questions, bill due in October and bill due in October full month. It is one and the same thing. And here you remember the difference between these one. Here it is 30th September. Suppose the bill is due on 31st October and the bill due in October. What is the difference between these two? Bill due in 31st October means the customer can come only on 31st October. Understand? He can bring the export bill only on 31st October. We call this is a fixed due date. Whereas in the case October, the bill due in October means the customer can come on 110 or any day between 110 and 31. Understand?
No, sir.
Yes, sir.
So the due date in the month of October means any day during October. The delivery or due date 31st October means only on 31st October.
Okay.
Similarly, the bill due in October full month also means the same thing. The same thing. Full month October also means any day during October. October 1st to October 31st. So in such situation, we will apply the buy low, sell high principle. If it is buying, we will give only the lesser rate. If it is selling, we will give the higher rate. Now look at the currency. The currency on a future date is increasing, isn't it? Currency is costly because if you draw a line like this, somewhere here it is spot. Here this is say July, this is say August, this is September, this is October. That means as time passes, what happens to the value of dollar? Value of dollar is increasing. The value of dollar is increasing. So if the delivery date is October means any day during October, after September, this is September end. So after September, any day during this period, the customer can bring. So in that case, whether we give the October premium or September premium, that is the point. September premium, what is September premium? Is 8 paise. What is October premium? It is 4 paise. Which one you give? Because our principle is
October.
September. Sir.
Yes. So that is the principle. So what is the rule? When the currency is at a premium and the transaction is a buying transaction, you have to allow the premium up to the previous month. Clear? So October, month of October means we give only up to September. Suppose it was a selling transaction. This was not instead of export, it was an import bill. What you take? The month of October. Currency is
Same month.
same month. That means October. So understand that concept very clearly. Or you just think this, our principle, we are following the direct quotation. In direct quotation, it is buy low, sell high. Therefore, we give only a lesser rate for buying and a higher rate for selling. Clear? So this is the case when the currency is at a premium. Look at, suppose the currency is at a discount. Spot rate is 79. July it is 78. August it is 77. September it is 76.50. And October it is 76. Suppose this is happening like this. Please mute. So a bill, a sale transaction due in October. So which one you give? Whether you give
October. We'll take October.
Yes, because here it is a selling transaction. So previous month means 76.50. Here it is 76. So in the case of a selling transaction, buy low, sell high. Sorry, this is 79.
So always it should be favoring us.
Yes, always it should be favoring us. So that is the rule to remember. Understand? So now somebody has not muted.
Please explain once again.
Again, I will explain. So here, these two has to be treated in the same fashion because we allow the premium up to September only. Bill due in October or bill due in October full means the currency is at a premium and it's a buying transaction. We allow the premium up to the previous month. So that means up to September. So what's the spot rate? Spot rate is 79.6030. So premium up to September. September is 8 paise 08. Add it 79.6830. Rounding of 79.6825. Same answer for D. Now look at E. Bill due on 8th October. Again, this is a fixed due date.
8 plus 1.
October 8th means you can allow the premium up to 8th October. So how do you do? September we know, up to September we know how much. Up to September it is 8 paise.
4 divided by 30 into 8.
Now say you for October you calculate. For the month of October is 12 minus 8 means 4 paise. So this 4 paise is for full month. So 7 days in October, you take 1/4, means 1 paise. So 8 plus 1, 9 paise. Therefore,
Is it 7 days or 8 days we have to take, sir?
it is 8th October. 8th October due means you can take 7 days. 8th October means 8th it is due. Approximately, when you round it off, hardly it matters. If you want more specific, how you have to do? 4 paise for the full month. So per day it is 4 by 31 into, you can take 8 days. Because due in 8 means you can allow up to 8.
Sir, why we rejected 7 from 12?
Not 7, it is 8 days. 8 days. Will due in 8 days. 8 days. 8 days you can take.
Sir, please repeat.
So why here the E is the bill is due on 8th October. Means it is a fixed due date. That means the customer is eligible for the premium up to 8th August. But here it is available up to September and up to October. But then we want up to 8th October. So up to 8th October, how we take? We take for up to September. This is up to September and then October 1 to 8. You have to add these two. Am I correct? So up to September, it is 8 paise. And October 1 to 8, you have to calculate using this formula. So roughly, you are getting it as 1 paise. It's 1 paise, no? Yes. 4 by 4. You can take.
Sir, how 4 by 4, sir? I didn't get it. 4 by 4 means what?
4 by 4 is for the full month. Now we want for 8 days. 8 days I have taken as 1 week. 1 week means 1 month is 4 weeks. So 1 by 4th I have taken. If you want more specific, you apply this formula. 4 by 31 into 8. You will get same answer. No, 1 point some decimal you will get. You get the same answer.
1.06.
Yes, sir.
Okay. So the answer will be 79.6030 plus 0.0.
Sir, why is it about 31? Sir, October is 30 days.
October 31 days na. 31 days na.
The 12 minus 8, 4 paisa. How we are doing 12 minus 8?
12 minus 12 is up to October. Already explained. You are not listening. October 12 paise means up to October. September 8 paise means up to September. See you. So for the month of October, it is 12 minus 8, 4 paise.
Sir, in this question, please explain question number A, sir. Bill date August 15th.
You have to allow the premium up to August 15th. How to get?
I didn't get that. Please, once more explain, sir.
No, you calculate the premium. What is given? Up to July given, up to August given. Can you calculate up to 15th August? You have granted a loan. You have granted a loan of 10,000 rupees to your customer.
Yes, sir.
You have charged interest up to June, say 100 rupees. And then the June interest up to June is 100 rupees. Then up to July, it is 150. The customer is asking, what is the interest for the month of July? How to calculate? Up to June, it is 100 rupees. Up to July, it is 150. What is the interest for the month of July?
Total, it will be 250.
50 only 50.
My question is, you have granted a loan of 10,000 and customer comes on June 30th. What is the interest? You said up to June interest is 100 rupees. You didn't pay. He went back. On 31st July, again it comes to you. What is the interest up to July? You said up to July it is
150.
My question is, what is the interest for the month of July? 50 rupees. 50 rupees. Customer is asking, can you tell me what is the interest for 15 days in July? How to tell you? 25 rupees.
25.
Same thing. See here, the bill is due in 15th August. So what is given? Up to July, 2 paise. Up to August, 4 paise. So we want for 15 days in August. How much it is? Up to July, 2 paise. Up to August, 4 paise. So for the month of August, 4 minus 2, 2 paise. So 2 paise is for the full month. So 15th August, half of it, 1 paise.
1 paise.
I'll skip. I'll go to the next one because.
Sir, what is the answer for D, sir?
It is here. All the 4 answers are here.
Sir, bill due in October full month means we have to take October now, sir, because full month.
October full month. October full month also means the month of October. October
Sir,
full
if they have
month
given 30th
refers
October.
to October full month means any day during October. October also means the same thing. I'll repeat once again. October full and October means the same thing. If it is 31st October or the last day in October, then it is fixed date. Here, full month October means any day during October.
So if it is an import bill, for example, if it is an import bill, then we will take the
Sir, bill due on October also any day between the October, and bills due on October full month means only on 30th day, no? Last day.
No. October full means any day during October. Month of October also means any day during October.
So both are same questions, no?
Both are same. October full and October means the same thing. Just to convey that, I have given it like that.
In question number
If if they mention the date, then it will be a date.
Exactly.
Otherwise, if they are given month or full month, it will be for first to, and then we have to take September.
Exactly. That's what I told you. If the date is fixed, 30th October or 31st October or 10th October, up to that day. If it is October or October full, any day during October. So in that case, currency is at a premium, buying up to the previous month, selling up to that month. That's what we have taken.
if it is an import bill.
Suppose in question number E, if it is 10th October.
If it is 10th October, again you have to calculate the proportionate. Suppose it is 10th October. See, for the full month, how much it is? 4 paise. So 4 paise is for 31 days. It is 10 means for 10 days how much? Proportionately you calculate. And add.
4 by 31.
4 by 31 into 10. Okay. It's October, it is 31 days. 4 paise is for 31 days. So per day you calculate and you do it.
So if it is an import bill, for example.
We'll move on to the next question. Computation of forward points. Forward points, I have given you the formula. It is spot rate into interest rate differential into the forward period divided by 12 into 100 or 360 into 100. Here there is a question. The spot rate of USD INR 74.50.55. So you have given.
Sir, don't mind. Can you mute all the mics, sir? Lot of disturbance coming. Sorry, sir. Disturbing class.
Okay. See, spot USD INR 74, 50, and 55 means that this is the buying rate, this is the selling rate. Interest rate for 3 months in India. So INR interest rate is 5.5, and in US the corresponding period in US it is 3%. Find 3-month forward rate. This is the question. So we want spot rate, it is given. We want interest rate differential. What is interest rate differential?
2.5.
It is 2.5.
2.5.
We want the forward period. What is the forward period?
3 months. 3 months.
So apply the formula.
74.50 into 2.
So to get the forward buying rate, spot rate 74.50 into interest rate differential 2.5 into
3 by 12.
3 by 12 into 100. Yes. Similarly, if you want the forward selling rate, take the spot selling rate 74.55 into 2.5 into 3 divided by 12 into 100. Very simple formula. Remember, instead of 3 months, suppose they have given 90 days or 60 days or 75 days. Then how do you move?
Divided by 365.
Not 365, 360. 360. 360, not 365. Remember that point. So here it is there. Solution. You got the same answer? Interest difference 2.5, forward period 3 months. Using the formula, you will get the buying points 0.4656. Then the higher interest rate is in India, so dollar is at a premium, so you have to add it, then round it off. Similarly, selling, you round it off, you will get the answer.
Sir, why is that 360 and not 365?
This is internationally accepted guideline. And FEDE has given it that for easy calculation, for 2 situations, the days are taken as 360. Number 1 for computation of forward points, and number 2 for computation of interest on FCNR deposit. Tomorrow, when you go back to your branch, you check if you have an FCNR deposit in your bank, the interest will be calculated. There are 2 basic difference between a FCNR deposit and a rupee deposit. But do you know what is meant by FCNR deposit? A foreign currency deposit. Yes, foreign currency. So we maintain in a permitted currency. Lot of some 8-9 currencies we maintain foreign currency deposit. For that, the interest is computed using the formula where the number of days is taken as 360 in a year. So these 2 situations, denominator is taken 360. For all other interest calculation, it is 365. It is a FEDE guideline. You cannot ask why it is. Why the majority in India, the majority attains at the age of 18. Can you explain? It's the Indian law, isn't it? Whereas in Hong Kong, it may be 21. A person attains majority in Hong Kong at the age of 21. That is their law. Okay.
Just wanted to know the logic behind it.
The logic means there is not much of logic for an easy computation. See, the denominator 365. For 360, you will get little more rounding off. That's all. So this is a principle. In principle, long back we have been following that. That's all. There is no.
Thank you, sir.
Sir, when we taken the interest rate differential from the 2 commodities, 2 rates, that are the Indian and US. So there will be the minus plus there. That will give the some difference or not?
No, minus plus. What you have to do? You find the difference. You calculate the forward points. Then you look at. Yes, you arrive at the forward points without putting the minus sign. Now what you have to do? Which currency is carrying higher interest? Here, which currency is carrying higher interest? Indian rupee or dollar? Indian rupee. So what is the guideline? The currency carrying higher interest rate will be always at a discount, or the currency carrying lower interest will be at a premium. See, the other way, when the currency carrying higher interest is at a discount means the currency carrying lower interest is at a premium. So here the currency carrying lower interest is USD. Therefore, USD is at a premium. So the forward points you have to add. Understand? So that is why we add the forward points. Suppose it is the other way. America it is 3%. Sorry, America it is 5.5, and in India it is 3%. Suppose, then you have to subtract. Fine. Okay.
Sir, also when the currency is at a discount, we have to subtract, no?
Yes, when the currency is at a discount, you have to subtract the forward points. When the currency is at a premium, you have to add the forward points. We have to, only the first session is over. Now, can I skip the MCQ?
Yes, sir.
Yes, sir.
No, sir, no.
Okay, but one question will.
Sir, on rapid fire, you can finish it up, sir.
Pardon?
Speed, we can go at a faster rate.
No, there are a lot of participants, so it will take much time. We can skip.
It's not, repetition is not
PPT will be shared today, na, sir?
I'll be sharing.
Oh, while sharing, kindly give the answer, sir.
Yes, this answer will be there. Look at this question. Just I would like to know whether you have understood. A foreign exchange deal was signed on Wednesday, 23rd December. Wednesday, 23rd December, and it was completed on 28th December. This transaction can be termed as cash ready, term spot, and forward.
Forward, sir.
All are saying forward.
No, sir. Spot rate, sir. 25th was holiday.
Person who is telling spot, can you explain? Can you explain why it is spot?
Sir, 25th was holiday.
Saturday, Sunday holidays.
Exactly. Yes.
Christmas, sir. Christmas, sir. Due to Christmas.
Christmas Friday holiday.
So remember, here
Since the
there are
holidays
three
are continuing,
holidays.
we will take only one holiday.
Pardon?
Only
That's
Christmas
what-
holiday will be taken into
Is
account.
holiday and Saturday, Sunday is also holiday.
See, that's what they have given. 23rd December is a Wednesday. They have given 23rd is Wednesday. Next working day is 24th. It is Thursday. Next working day is 25th, Christmas. That is Friday. Then Saturday, Sunday, holidays. Then 28th is the second working day. So that
That
means
is
it
Tom,
is,
no, sir. Tom.
it is sport. It is sport.
Second working day.
Second working day. Second working day. So like that, the questions will be asking like that. Okay. And we'll move on to the. Okay, we'll move on to the next one. One second. How long you can sit? Do you have any other session today?
No, sir, no other session as long
other
as
session.
will be there.
So, can we sit some more time? Little more?
Yes, sir.
Sure.
Yes, sir.
Yes, sir. We can sit for some more time.
Okay. So now, in arithmetic, I am going to discuss an important topic, that is cross rate mechanism. Yes, in cross rate mechanism, this is recap. This is what we have just discussed. I'm leaving it. We'll move on to cross rate mechanism. So what is meant by cross rate mechanism? Again, just like this, the buying and the selling of forex transaction, some of the candidates find it very difficult to understand the concept of cross rate mechanism. I will explain as simple as possible, because see, you have two quotation available. One is, suppose you have a quotation USD INR. This rate is say 78.5060, and you have another code GBP. Somebody has not muted. Please mute all. So you have another code GBP USD 1.2526. Just an example to understand. I am explaining. See, the first code, what does it say? This code says $1 is how much Indian rupee. Am I correct? This code says the bank will buy $1 at 78 rupees 50 Indian rupee, and the bank will sell $1 at 78 rupees 60 paise. Now, GBP USD, what does this code says? This code says bank buy 1 GBP at $1.25. So if a customer is giving GBP, bank accept GBP and give 1.25 USD. Similarly, if a customer wanted GBP, the customer has to pay 1 GBP, $1.26. That is the meaning of these two. Understand? So these are the two codes available in the market. Parul Dwivedi, you have any doubt? I have not explained
No,
anything.
sir. No, sir. It's understandable.
These are the two quotations available. Now, your issue is you want GBP INR. That means you want to know 1 GBP how much Indian. Understand? Here directly that is not available. The available quotation is $1 how many Indian rupee and 1 GBP how many dollar. Just like you may it is not actually happening. Suppose a market trader is selling. I say if you give 1 apple, I will give you 4 orange, and for 1 orange I will give you 3 lemon. So then 1 apple, how many lemon I can get? So similarly, like that questions. So here $1 is equal to how much Indian rupee? 1 GBP, how many dollar? So from this 1 GBP, how many Indian rupee? To find out that, we use the gross rate. Understand? So this mechanism can be applied only if in the two quotation there is a common currency. Here, what is the common currency? Here, dollar.
USD.
Here, the dollar is the base currency. Here, the dollar is the quoting currency. Or I can say that the common currency is on the opposite side. Am I correct? Because here it is in the, if you look at just like a fraction, this is in the numerator, here it is in the denominator. So the common currency lies on the opposite side. So the rule is cross rate mechanism, the rule is multiplication. Just remember, look at, if you want to apply the cross rate mechanism, look at the two rates. There will be a common currency. And where the common currency? If the common currency is on the opposite side, the rule is multiplication. That means if you name this as equation number 1 and this as equation number 2, and if you want GBP INR, the multiplication I will explain, just like fraction, if I multiply, this will reduce to like this, USD by INR into GBP by USD. USD gets cancelled. What is remaining? GBP INR. This is the rule. Therefore, if you want GBP INR buying rate, what you have to do? You have to multiply the buying rate of 1 with the buying rate of 2. What is buying rate of 1? 78.50. What is buying rate of 2? 1.25. You simplify, you will get the buying rate.
98.125.
Yes, whatever it may be. Now, similarly, if you want the selling rate of GBP INR, you have to multiply the selling rate of 1 into the selling rate of 2. So what is the selling rate of 1? It is 78.60 into the selling rate of 2, 1.26. You multiply and round it off. This is the rule. Is it very simple? The rule is very simple. Yes. What is cross rate mechanism? You have two quotations, but in the two quotation there is a common currency, and you want the value of the third currency. So there you can apply the cross rate mechanism. There are two situations. We have discussed the first situation. First situation is common currency on the opposite side. Now we are going to discuss the second situation where the common currency is on the same side. That we will discuss subsequently. So when the common currency is on the opposite side, the rule is multiplication. Multiplication means to get the buying rate, multiply the two buying rate, to get the selling rate, multiply the. Is it very simple?
Yes, sir.
Understood. Is the situation. I've given just an example of that fraction and all. Don't bother about. Look at the two situations. USD INR is given. GBP USD is given. First, you name as equation number 1. Second, number 2. There is USD, the common currency. We want GBP INR. So the common currency on opposite side, rule is multiplication. You multiply the two buying rates. So 78.9 into 1.2050. Then you round it off. You will get the answer as 795.0750. Similarly, if you want the selling rate of GBP in terms of INR, multiply the two selling rate. 78.91 into 1.2075. Then round it off. So club the two rates, buying rate and selling rate. So GBP INR is 95.0750 to 850. Okay, we'll move on to The second situation.
Sir, previous sir, please. Problem is there. Not this one, sir. Previous one.
This is the one. What I've written, you want that? That is a reason. What? This is the one. This is the problem. Not problem.
Okay. Okay, sir. Thank you, sir.
Already explained. Okay. Second situation. So first, I told you the common currency opposite side. Next situation will be like this: USD INR. Next is USD GBP. So suppose USD INR is 79.3040 and USD GBP is 0.815060. Now look at here, the common currency is dollar, but dollar is the quoting currency in both the quotation. Am I correct? So here, if we multiply, if you name this as equation number 1 and equation number 2, when you multiply, dollar will not get cancelled because that is on the same side. So here, what we have to do is, you have to reciprocate this one. You have to, from USD GBP, you write GBP USD. So how to write GBP USD? You have to reciprocate this also. But here, remember, while doing the reciprocation, when you take the reciprocal, here it is the reciprocal of the selling rate, and here it will be the reciprocal of the buying rate. That means it is 1 by 0.8160 and 1 by 0.8150. I'll repeat once again. You have given USD GBP. We have to take the reciprocal of this. That means GBP will come first and USD comes second. So when you reciprocate this, here it is not the same way. The selling rate reciprocal should come at the buying rate, and the buying rate reciprocal will come at the selling rate price. That point to remember. So it is 1 by 0.8160 will be the buying rate, and 1 by 0.8150 is the selling rate. Now this you name as equation number 3. Now you look at equation number 1 and 3. 1 is USD INR, 3 is GBP USD. So the common currency is dollar, which is on the opposite side. So when the currency is on the opposite side, what is the rule? Multiplication. So if you want the buying rate, it is buying rate of 1 into buying rate of 3. That is equal to, what is buying rate of 1? 79.30 into buying rate of 3, 1 by 0.8160. Similarly, if you want the selling rate, it is selling rate of 1 into selling rate of 3. What is selling rate of 1? 79.40 into 1 by 0.8150. You simplify this. Any doubt?
Sir, please repeat this one. Sir, please repeat this one. USD in same side. That's why we are using this one. No.
Yes. When the common currency is on the same side, you cannot use the principle of multiplication. Then you have to reverse it. So that means you have to reciprocate it. When you reciprocate USD GBP, it becomes GBP USD. So when it becomes GBP USD, the reciprocal on the other side will be, reciprocal of buying rate will be the selling rate, and reciprocal of the selling rate will be the buying rate. That's what I have written. 1 by selling rate will come in the buying rate place, and 1 by buying rate will come in the selling rate place. That is the only one point to remember. Then it is the same thing. Okay. So I'll move on to that step. We'll do some question, then it will be more clear. USD INR and USD SGD is given. From 2, we can get SGD USD by reciprocate. It is the reciprocal of selling rate by reciprocal of buying rate. So hence, the buying rate is reciprocal of selling rate, like that I have written. Then you multiply and then round it off. Okay. Next is fixed rate and floating rate. There are two mechanisms. Some of the countries in the world are following the fixed rate mechanism, and some other countries, they are following the floating rate mechanism. The major countries in the world, they have switched over to the floating rate mechanism, and India also switched over to the floating rate mechanism in the year 1993. Now, what is in fixed rate? In fixed rate mechanism, the rate of the currency is fixed by the central bank. In India, the central bank is Reserve Bank of India. So in India, we are not following the fixed rate, we are following the floating rate. Only very few countries are following the fixed rate mechanism. And it helps, what is the benefit? The fluctuation will not be there, and currency value will remain in a narrow band, and it avoids speculation, and government can check the inflation. So the example are UAE, Saudi Arabia, and etc. Those countries, they follow the fixed rate mechanism, because when dollar is UAE dirhams, that is AED is pegged to dollar, it is fixed for some time. It is 3.67, and after say a period, say after 6 months or 1 year, the central bank of UAE, suppose they review the situation, and they may slightly change. Either they will, if dollar is appreciating, they will put instead of 3.67, they may make it 3.68 or 3.69. So that is called a fixed rate mechanism. So fixed rate mechanism means the value of the currency is not affected by demand and supply. It is fixed. The exchange rate is fixed. So here UAE dirhams is fixed to dollar. So that means always 3.67. If they give UAE dirham 3.67, they get $1. This is the mechanism of fixed rate. Whereas a floating rate means the value depends on the supply and demand factors. Most of the countries follow this, and we follow in 1993. World economics follow in 1993, and that is what with respect to fixed rate and floating rate. Just like our fixed rate interest and floating rate loan. Next is arbitrage. What is meant by arbitrage? Arbitrage means simultaneous buying and selling. It can be a currency or it can be a commodity at two different locations. And this happens because of the inefficiencies in the market. And there are two types of arbitrage. One is simple arbitrage, another is compound arbitrage. I'll give an example. Suppose a person buys USD from New York market, say at 78 rupees 50 paise, and he brings it to Mumbai market and sell it at 78.60. This transaction is called an arbitrage transaction. So simultaneously, a person is buying dollar from New York at 78.50, and he is selling it at Mumbai at 78.60. So straight away he gets a profit of 10 paise. This is an example of a direct arbitrage or a single arbitrage. Here two locations. One is New York, another is Mumbai. See, there can be another situation. A person buy USD from New York, sells it in Singapore, and say sell it, and he gets Singapore dollar, and Singapore dollar he brings to India, and he sell it in New Delhi. So there are three locations are there. One is New York, another is Singapore, and third is New Delhi. So this we call it is a compound arbitrage or a 3-point arbitrage. Clear? So what is arbitrage? Simultaneous buying.
Once again.
Arbitrage means simultaneous buying and selling at two different locations. It can be a currency, or it can be a commodity, or it can be a stock. For example, a person buys from the National Stock Exchange, Tata Motors share, say at 550 rupees, and then he sell it at Mumbai Stock Exchange exchange and say 555. So he gets a profit of 5 rupees. So here this is doing simultaneously. He's not waiting for some time and selling. That is a different thing. Simultaneously buying at one market, selling at another location. That is called arbitrage. Is it clear? Simultaneously, if two locations are involved, we call it a simple arbitrage. If more than two locations involved, just like person buy dollar from New York, sell it in Singapore, convert it to Singapore dollar, and take Singapore dollar, and that he brings to India and sell Singapore dollar in Mumbai or New Delhi and get Indian rupee. So that is called a 3-point arbitrage. I'll give an example, then it will be more clear to you. So I think this question they have asked. 1 second. This is stuck. 1 second. Yes. Yes, this is the question. On a particular day, the following are the exchange rates prevailing. 1 GBP is equal to USD 2.4110 in New York. And 1 USD is equal to Euro 1.050 in Frankfurt. And 1 GBP is equal to 1 Euro in London. An arbitrator. Who is an arbitrator? In the morning session, I told you about a speculator. Who is a speculator? Speculator is a person who speculates a deal. That means he doesn't require any forex, but he buys in bulk, hold it for some days, and when the price improves, he sells it. We call him a speculator. Who is an arbitrator? Arbitrator is a person who indulges in arbitrage transaction. That means simultaneously at 2 or 3 locations, he buys from one and sells at the other one. Here there is an arbitrator. He starts his business in New York. So he is having 1 GBP there. So he converts this 1 GBP into dollar. How much he got? He got 2.4110. Then with this dollar, he goes to Frankfurt and convert dollar to euro. And again, this euro he convert to GBP. Now, what is the profit he made in this transaction?
2.4.
How to move about?
0.05 euro.
We'll start. See, can you tell me now? You look at these two rates. Look at these two rates. From this, can you tell me 1 GBP how many euro? How to get that? See, what is this 1 GBP is equal to USD means what is the rate? The rate is GBP USD. Am I correct? It is 2.4110. What is the next one? Next one is USD. What is it? 1.05. You may have a confusion, only one rate. That is very easy for us. They have given one rate. Take it, buying or selling. We are confined to that one rate only. Now, this is GBP USD and this is USD Euro. Apply the cross rate method. Can you tell me GBP Euro from this?
2.53155.
Yes, it is 2.4110 into 1.050. Tell me how much it is?
2.5315. 2.5315.
So he started from New York. He is having 1 GBP. That 1 GBP he converted to euro. 1 GBP, how many euro he got?
2.53.
Yes, 1 GBP is equal to 2.5315 euro. Now he goes to London. So what is the rate in London? 1 GBP is equal to 1 euro. From this euro, how many GBP he gets? He's having 2.5. 2.53. Yes, so he gets 2.5315 GBP. So he started the business with 1 GBP in New York, isn't it? Now he got 2.5315 GBP. So what's the profit?
0.5315.
This is the answer. I think a similar question asked in the previous time, this June exam. Somebody has written, I think, from that day.
Then we have to round it off, na, sir?
Pardon?
Round it off, no?
Round off? Why round off? You cannot round off. Here, there is no Indian rupee.
Okay, okay.
So profit is how much profit, sir?
1.5315 GBP. He started the business with 1 GBP, and at the end in London, he finishes with 2.5315 GBP. So his profit is 1.5315 GBP. Clear?
No, pardon, sir. Did not get, sir. Pardon, sir.
Did not get.
How are getting 1.5315?
In question last point you have to read.
You have to look at the question. What is the given thing? These are all the things given. He started the business in New York. When in New York the rate is 1 GBP is equal to USD 2.4110. So he is having 1 GBP. How many dollar he gets? He gets $2.4110. Am I correct?
Yes.
Okay. So with him, how he is having $2.4110. Now in Frankfurt, what is the rate? Or if you give $1, they will give 1.050 euro. This person is having $2.4110. How many euro you will get? For $1, 1.050. For you multiply. Or you use the cross rate mechanism. So one multiplication, you got 2.5315. So he started in New York. He is having 1 GBP. He converted to euro. He got 2.5315 euro. Correct?
Yes.
Now he moves to London with 2.5315 euro. And in London market, the quote is 1 GBP and 1 euro are equal. If you give 1 GBP, they will give you 1 euro. That means if you give 1 euro, they will give 1 GBP. So this person is having 2.5315 euro. And he asked, give me euro. Give me GBP. How many GBP they will give? They will give 2.53 GBP. He is having 1 GBP. Now his value, the money becomes 2.5315 GBP. So what is the profit? 2.5315 minus 1 means 1.5315. This year I have sold it. I have rounded off to only 2 decimal. That's what it is, 1.53. You can look at the answer. If it is 4 decimal, you can write the other one. So this is with respect to arbitrage. We'll move on to a very important slide. And most of the candidates will have so many doubts in this. I told you there are 4 types of rates. Sorry, there are 2 types of rates. One is buying, another is selling. Now the buying can be further subdivided. Broadly, you can have buying rate and selling rate. And the buying
1 minute, sir. Previous slide, please, sir. 1 minute, sir. Okay, sir. Thank you, sir.
Okay. So the buying, again, you can subdivide into 2. One is the TT buying rate and another is the bills buying rate. Similarly, the selling also you can subdivide into 2. One is TT selling rate, another is bills selling rate. So if a transaction is given to you and you will be asked what is the rate to be applied, then you should have a very clear understanding whether you apply the buying rate or selling rate. That is number 1. If the bank is buying, bank will apply the buying rate. That means when the bank is receiving forex, we apply the buying rate. Or when the bank is giving forex, we apply the selling rate. Now again, the buying rate is subdivided into two. One is TT buying. TT stands for telegraphic transfer. This is an old way of expressing, but that we follow, we continue it now also. Because earlier, the first communication before the intervention of invention of these things and the latest development in telecommunication. See, because now nobody send a telegram. Am I correct? If you want to communicate immediately, what you will do? Either you make a phone call or you make an email, isn't it? So that means it is very fast. The same time it reaches there. But if you look some 25 years back or 25-30 years back, that time this much communication advancement was not there. Therefore, that time for speedy communication we had to depend on telegram, and that's what the name came, TT, telegraphic transfer buying rate. So TT buying and bills buying, TT selling and bills selling. So when do we apply the TT buying and when do we apply the bills buying? It's a very simple thing. See, I will give an example. A customer, suppose a customer comes to you. He gives a check. He gives a check. See, if I write it again, it will go. Okay, suppose a customer is giving you a check for $1,000 and he is requesting you send it on collection. I don't need the money now. Suppose today is a working day. And the customer is coming to you and is depositing a 1,000 USD check. And customer says, you send it on collection and pay me after realization. So what the bank will do? The bank will lodge it in your system, then make a covering and send through international courier to your correspondent bank in US. And that will be presented in, just like we have a CTS clearing, they have a clearing, and in that clearing it will be presented and it will be paid and the proceeds will be credited to your account. Now, the correspondent bank will intimate you. Your collection item has been realized. We have credited your account with 1,000 USD. After getting the information, you give the credit to the customer. So in that case, we apply the TT buying rate. This is one situation. So you accept, one second. You accept the check on collection. You accept the check on collection basis, on collection, and subsequently you credit. Second situation, this is first situation, and second situation, I think some dust is there. Second situation, the customer gives you the check for $1,000 and he says, give me the credit immediately, now itself. So the customer is giving you the check. He wanted the rupee equivalent today itself. So you apply the rate today and credit customer's account. And this check will be sent abroad through your correspondent. And the nostro credit will happen after 10, 15, 20, 25 days. Is it clear? So these are the two situations. So in this situation, we apply the bills buying rate. So this is the difference between TT buying rate and bills buying rate. So TT buying rate will be applied when our nostro account is already credited. What is meant by nostro account? Our account with a bank in India. Yes, we will in the next session we will be discussing about correspondent banking and other things. So now just understand, nostro means our account with you. So if a bank in India, say State Bank of India, is maintaining a dollar account with the Citibank New York, this we call it's a nostro account of SBI. So the nostro account is credited, and afterwards you are giving the money to the customer. We apply the TT buying rate. But the customer wanted the money immediately, so you pay the rupee equivalent to the customer now, and you get the credit after 15, 20 or 25 days. Then in that case, we apply the bills buying rate. Understand? So this is the basic rate. So if this is 75 rupees, what will be bills buying rate? Is it more than 75 or less than 75?
It should be more than 75.
will be less than 7 because we have to load the interest factor. Understand? So TT buying means already we received the foreign exchange. You are giving money to the customer. In the case of bills buying, you are giving the money to the customer now and you get it on a later date. Understand? So among the two, bills buying and TT buying will be more and bills buying will be less because our principle is buy low, sell high. Now coming to TT selling. See, only two type of transaction we apply the bill selling rate. One is import bill realization. Import bill, you know what is import bill? Somebody is importing a commodity or a machinery or a vehicle from a foreign country and the bill will come to you. You have to make the payment. That is called the retirement of import bill. So in the case of an import bill payment, retirement means payment. Payment of an import bill, we apply the bill selling rate. Similarly, crystallization of import bill, we apply the bill selling rate. For all other transaction, it is TT issue of a draft, or for all other sale, it is TT selling rate. Now I'll explain it in the slide. I'm just rub this. Now look, here it is. These are all the various type of transaction for which we apply the TT buying rate. Remember, in the question, sometimes only buying rate is given, you can take it like that. If TT buying and bills buying is given, then you have to clearly understand whether you have to apply the TT buying or bills buying. If only buying rate is given, you cannot go for TT buying. That rate can be taken as for bills buying as well as TT buying. Understand? So what are the items for which we apply the TT buying? On clean inward remittance. You have received a remittance from abroad. Next, realization of export bill sent on collection. Just I explained, you have sent an export bill on collection and it realized. Then cancellation of a draft. You have issued a draft. Now the customer comes for cancellation. Apply the TT buying rate because already the money is with you. Then cancellation of a forward sale contract. Here we apply the TT buying rate. Here, one point remember, because in the numericals we'll be discussing, a forward contract can be of two types. One is a purchase contract, another is a sale contract. Because in a purchase contract, customer and banker enter into a contract for purchasing. So the bank will purchase from the customer. That is a FPC. So FPC, one is FPC. FPC means forward purchase contract. Here the bank undertake to purchase the currency from the customer. And the second is forward sale contract. Forward sale contract, what the bank says? Bank says we will sell to you on a future date. So that is so there are two types of forward contract. One is forward purchase contract, another is forward sale contract. Now a customer had booked the contract. Means he wanted to put through the transaction after some time. So banker and customer enter into an agreement. So it's a stamped agreement and it is binding for both the parties. Okay. Now the customer could not undertake. So the customer will come to you, please cancel it. Or you extend it. Extension is not possible, we have to cancel it. So for cancellation, the FEDE guideline is, for cancellation, you have to apply the opposite TT rate. That is the guideline. So a purchase contract, you have to apply the TT selling rate, and a sale contract cancellation, apply the TT buying rate. That's what cancellation of a forward sale contract, it is TT buying rate, and the cancellation of a purchase contract, it is TT selling rate. Here it is. Now next is closure and conversion of FCNR deposit. A customer is having a deposit in a GBP. That means already the foreign exchange is with you. Now either on due date or before due date, customer comes you, please close, give me Indian rupee. Then again you apply the TT because already the forex is with you. So closure and conversion of FCNR or RFC account, resident foreign currency account, to Indian rupee. Similarly, there is another one here, conversion of NRE to FCNR. Here what is the conversion? Customer is having Indian rupee. He wanted a foreign currency deposit. That means you are selling. So apply the TT selling rate. Next is realization of crystallized export bill. Here comes the word crystallization. I will explain what is crystallization. Now you just remember, an export bill has been crystallized. subsequently it is paid. Then we apply the TT buying rate. So this you remember, this rate we apply when our nostro account is already credited. And bills buying we apply when the nostro credit takes place on a later date. You give the money now and nostro credit will take place on a future date. So these are the transactions for which you have to apply the TT selling rate: issue of a draft, issue of a SWIFT remittance, cancellation of a purchase instrument, bill purchased returned unpaid, crystallization of export bill, refund of inward remittance, cancellation of forward purchase contract, conversion of NRE fund to FCNR. So these are all the different types of transactions for which you have to apply the TT selling rate. Then bill selling is for retirement of import bill and crystallization of import bill. So among the four rates, which is the lowest? The lowest is bills buying, and which is the highest? It is bill selling. So the lowest is bills buying and the highest is bills selling rate. So bill selling is not favorable to the customer. TT selling will be favorable to the customer because TT selling will be less than the bill selling rate. Any doubt? And apart from this, the bank will be quoting the currency note buying and selling and traveler's check buying and selling. So tomorrow when you go to your bank, you can call for the rate circular every day by 10 or 10:05. Your international division or forex department will be publishing or giving you through your intranet the exchange rate. And that keeps on changing. But at 10 o'clock or when they take the rate, that is the base rate. Based on that, they will do the transaction. So they will give these four rates: TT buying, bills buying, TT selling, and bill selling for the major currencies. Apart from that, they will give currency not buying, currency not selling, and traveler's check buying and traveler's check selling in various currencies: USD, Japanese and Canadian dollar, GBP, Euro, like the major currencies. They will give the rate. Okay. Any doubt on this slide? I'll explain what is crystallization. Crystallization, again, candidates will have so many doubt in crystallization. Crystallization means there are two types of crystallization. One is export bill crystallization. Next is import bill crystallization. Import bill crystallization is under letter of credit. So then you should know what is meant by a letter of credit that we are going to discuss in the next section. So now I'll explain what is an export bill crystallization. See, an exporter comes to you. So there is an exporter. You have an exporter client. He has submitted a bill for, say, US dollar 1 lakh. And you suppose you have purchased it when the rate was, say, 78 per dollar. So how much you will credit? You will credit 78 lakh to the customer's account. And you send the bill abroad. So what is the customer is, when he submit the bill for 1 lakh USD, what the customer is promising? I have shipped goods worth 1 lakh dollar. And please take the document. You present it there. You will get 1 lakh dollar from the buyer. Understand? So this is the undertaking given by the exporter. Now you, based on the promise or based on the set of documents submitted, you purchased and credited customer's account. Now you have credited 78 lakh rupees to the customer. But what is the customer's profit? Customer says you will receive 1 lakh dollar. That is the promise. Now you, based on the promise, you send abroad, but the buyer is not making the payment. So the buyer is not making the payment. You have already given the money to the customer. How long you can wait? There is a clear guideline. Earlier it was 30 days. That has been taken away. Now individual bank, RBI says, individual bank can decide when an export bill is to be crystallized. So depending upon the customer, the country of export and the commodity, bank's board will decide various dates. So suppose it is 30 days. That means a bill has been negotiated on 1/9. So 30 days is completing on 39, or you can say 110. Now the due date means before this date or 110, they have to get the payment, but the buyer is not making. So this date you have to crystallize. And what is the crystallization? On this date.
Sir, please repeat this one. The date.
19, you have purchased the bill at 78, and the customer promised, customer will, the buyer of the commodity will pay $1 lakh, but the buyer is not making the payment, and the due date has come. Then on this date, the bill has to be crystallized. That means the liability of the customer has to be converted from foreign currency to Indian rupee. Till the crystallization, the customer's liability is $1 lakh. Now on crystallization, suppose on 110, the value of dollar moved to 79. Then you crystallize at 79 and the customer's liability becomes 79 lakh Indian rupees. So this process is called crystallization. So if I say an one sentence definition, the crystallization of an export bill means it is the conversion of the foreign currency liability into Indian rupee liability. Because till the date of crystallization, the exporter's liability was $1 lakh. When it is crystallized, the customer's liability changed from $1 lakh to 79 lakh Indian rupee.
Sir, this process, we already credited the 78 lakh on 19 itself, sir.
Yes, 19 you have credited 78 lakh to the customer.
Yes.
And you wanted the money within 30 days. So the last date has expired. The dollar has not come. Now you crystallize the bill and you recover 79 lakh from the customer. That is called crystallization. Understand? So the customer cannot say, you have given me only 78 lakh. How can you recover 79 lakh? It is
dollar rate has been come down, sir. If dollar rate
same. Suppose the value of dollar has become 77. Then you debit only, the customer need to pay only 77 lakh. In that case, customer is gaining.
Okay.
It's a cancellation of export bill, sir?
It is not cancellation. This is not cancellation. What is cancellation? Cancellation of an export bill doesn't arise. See, when you send an export and they can return it, you cannot cancel. Only you can cancel a forward contract. When you ship, export means you ship. How can you cancel it? You have shipped the goods. Now it can be returned. See, a person has exported and
sir, what is the use of this type of transactions to the bank?
Sir, in this situation, 1 lakh lost to bank, sir.
See,
what is the use?
No, you tell me. See, when a customer exporter, you have an exporter client. Customer do an export. He is submitting the bill. As a banker, it is your responsibility to honor his bill. No, isn't it? See, when a customer is an exporter, he is your client. He is doing export. So when he does export, how he get the money? He can get the money through a bank only. So he has to submit the document to the bank, and you have to pay him. If you are not convinced, you need not purchase. You can sell it on collection basis. In that case, crystallization doesn't arise. Understand? But if the customer is known to you and he is a respectable customer or he is a well-rated exporter and he submits the document, you have to purchase it.
Sir, is it one sort of non-fund based credit?
It's not non-fund based, it is a fund based. What is non-fund based and fund based? You are giving money to the customer. It is a fund based credit.
It is kind of check purchase that used to happen in banks.
Same thing.
In past.
Sir, here we are giving the INR credit to the customer 78 lakh. When the US rate is coming down, the bank is at a loss, no, sir. Who will compensate that?
There is no loss. No loss. Here comes the dealing room operation. Wait. Here comes the dealing room operation. See what the dealer will do. when a customer is giving you an export bill of 1 lakh and the bank is quoting 78 rupees, how the dealer is quoting 78 rupees? The dealer immediately or before quoting, they will do an opposite transaction. That means what they will do? They will do a sell. They will do a selling transaction. When they buy from the customer, for every merchant transaction, they have to do an opposite transaction. That means every purchase, they will do a sale, and every sale, they do a purchase. Understand?
Got it.
So therefore, here this purchase, when they purchase at 78, immediately the dealer had sold this 1 lakh at a rate more than 78, maybe 78.10 or 78.20 or 78.20, depending upon the situation. Understand? Then only they will quote 78. If a dealer quotes 78 to a customer for buying an export bill, the dealer might have sold it at a higher rate, 78.10 or 78.20. So this, suppose they have done a sale transaction at 78.10, and suppose this bill is purchased by SBI. This sale is done with the Bank of Baroda. How this sale the bank can do? When the customer gives this dollar, that means when the bill is realized, that money State Bank of India will give to Bank of Baroda. That is the promise. But now the bill is not getting realized. That means SBI is not getting forex. So this the other contract is lying there, where State Bank of India has to give $1 lakh at 78.10. So from where SBI will give? SBI will go to the market, interbank market. When SBI goes to the interbank market, what is the rate apply? SBI wanted dollar. SBI go to the market. PNB is having dollar. So what rate PNB will apply? Whether they will apply the buying rate or selling rate. Here is the confusion. This is something tricky. They will apply the selling rate. That's what crystallization of export bill. The rate is TT selling rate. It is selling rate. For purchasing, you applied the bills buying rate, but for crystallization, you have to apply the TT selling rate. That also question they used to ask. Crystallization of export bill. What is rate applicable? It is TT selling rate. The reason is this. When they purchase, that's what. As a banker, we don't keep forex. Any bank will not keep. Very minimal amount only they will keep in the nostro account. And other amount, they will dispose of. Why the reason? The reason is two. Number one, exchange rate fluctuation. Number two, parking the money in the nostro account. It is a current account. No interest is received. Therefore, these two reasons, any bank, they will keep only a minimum amount in the nostro account, and the entire amount or almost near to that, the purchase will be done by a sale, and the sale will be compensated by a purchase. This point to remember. Therefore, export bill purchase at 78 means they might have done a sale transaction. And this sale will be completed when the exporter or the buyer, this export bill realizes, but the bill is not realizing. When the bill is not realizing, SBI cannot back out from Bank of Baroda contract, because SBI said, Bank of Baroda, we will give you $1 lakh at 78.10 after the 25 days. The date also they fix. So then they go to the market on 110. They go to the market, and what is the prevailing rate? At the rate they buy and pay. So how the bank is putting a loss? The bank is not putting a loss. Isn't it? Because if they get it 77, fine, they get it 77, but Bank of Baroda will pay 78.10 because already the contract has been booked. Understand? Similarly, if it is 79, the difference has to be borne by the customer. The difference amount will be debited from the customer's account. So this process is called crystallization. So here two questions can be asked in crystallization. Number one, what is the time limit? The time limit is discretion of the bank. And what is the rate applicable? The rate applicable is TT selling rate. TT selling rate. And you should know what is meant by crystallization also. Coming to import bill. Import bill also same thing. Import bill means import bill drawn under letter of credit only crystallization. What is import? Somebody has ordered a product. Suppose your customer, he has requested he wanted to import a car from Japan. So he had made the transaction. So they have shipped the goods. The car has come to India, and the document will reaches you. then you request the customer, see, your document has come, please pay the money. If the customer is not making the money and you have not opened a letter of credit, you need not pay because you have no obligation. Suppose this import has been done based on a letter of credit, means you have issued a letter of credit. We'll learn it later on. Letter of credit means the bank is giving an undertaking. You ship, we make the payment. So in such case, even though the importer is not making, you will have to make the payment. Then we crystallize at that day's bill selling rate and pay the money and recover from the customer. So that is what crystallization of import bill. So there also the timeline, discretion of the bank, and the rate applicable is, it is bills selling rate. Okay, so that is with respect to crystallization.
In this condition, we can take the advantage of ECGC.
ECGC is something different. ECGC means it is you can take the credit. You can get the insurance. Non-payment will cover. Political cover and commercial risk are there. You can take, no doubt. Dealing room operation. So what is dealing room operation? It's a service branch, and branches dealing room will do two types of transaction. Already I told in the beginning. One is customer related transaction. We call the merchant transaction. Next, they do the trading related transaction, and that is proprietary trading, undertake proprietary trading. Then they manage the nostro account and the foreign currency assets and liabilities. So these are all the functions of dealing room. Now they act as a separate profit center. Now as a dealer, they have to maintain two positions. One is funds position, another is currency position. What is funds position? Actual balance in the nostro account. So we'll discuss about the currency position. It is the net position on a particular day. The position means mismatch in purchase and sale. Foreign exchange risk. Open position, there can be two. One is long, another is short. I will give an example. Suppose on a particular day, a bank purchased US dollar. This is buying US dollar 100 million, and they sold US dollar 75 million. So here the position is open. Why? There is a mismatch. And what is the mismatch? 25 million. This is one situation. And this position we call, this is overbought, or overbought is called a long position. Now next situation, purchased USD 100 million and sale USD 120 million. So again, here the difference is 20 million. This is the open position. Here, this is oversold. Oversold is also known as short position. I'll repeat once again. And there can be another position, and means nil position. What is nil? What is nil position? Or you can say square position. Yes, equal. Yes. 100 million purchase, 100 million sale. So here the open position is 0. You can say square, or you can say the open position is nil. So there can be three situations, but generally a bank cannot have this one. Square position, very rarely it happens. It will be either long or short. Clear? Long means overbought. What is the meaning of overbought? Here they have purchased 100 million, but they could sell it only 75 million. So the difference means 25 million they have purchased in excess. That is called overbought. Overbought is also known as long position. Second situation, it is 100 million, but they sold 120. You may have a doubt how it is possible. They have only 100 million. How can they sell 120 million? Can anyone answer?
Increasing of dollar value, sir.
Sir, speculation.
Speculation. Not speculation. No, it's not speculation. Because in spot transaction, you get 2 days for settlement. Isn't it? Today you purchase, you sell 100 million or 200 million, and you get 2 days time to make the payment. You for settling, isn't it? That is spot. That is spot. So that's what. So 100 million they purchase, they can sell 120, no doubt, because even they sold 120 in excess of 20. This 20 they have to cover in 2 days time. In 2 days working, 2 working days, they can do it. Understand? That is the reason it can be overbought or oversold. Overbought is known as long position. Oversold is known as short position. Both are risky as far as the bank is concerned, because the rate is keeping on changing. Sometimes it may give a profit, sometimes it may give a loss also. So that's what open position, overbought and oversold. I give an example, 180, and then it is a long position, then bought euro 200, sold 250. That is a example for a short position. I think a long and short is clear. This is with respect to currency position. Now coming to funds position. Funds position means actual inflow and outflow in the nostro account. It includes both ready and forward transaction. So mismatch result in interest rate risk. Here the mismatch result in exchange risk in the case of currency position, and funds position, it result in loss of interest or excess of interest. Because in the nostro account, suppose it is overdrawn, they will charge OD interest. Suppose there is a surplus in the nostro account, you are losing the interest, isn't it? Therefore, that is with respect to mismatch in currency and funds position. So remember, a dealer has to maintain two positions. A dealer has to maintain two positions. One is funds position, another is currency position. Funds position means the net balance in the nostro account. Every day, what is the balance in the nostro?
Sir, please in next class.
Pardon? Hello?
In next class.
Next class. Oh, okay. What's the time now? Oh, you have to go for lunch. Okay.
1:46.
Is it fine? I'll stop at 2.
No, sir.
No, sir. It's
No, sir.
more than 4 hours.
This is the first time we are going to exam, sir.
Okay. Then I'll stop it here. Fine. We'll begin. See, I will share the 2 days, the 2 sessions, the PPT. It is in 2 lots. 2 set of PPTs I will be sharing. Please go through it. Understand the concepts. Because the next session, next 2 sessions, we will be doing the numericals. So there, the application of these things will be there. Application of buying, selling, and all those things. Okay. So unless this is thorough, you may not be able to follow further steps. Okay.
Can you please explain once the cancellation of an export bill? So what rate will be applied?
For cancellation of an export bill?
Yes, sir.
No, cancel. I told you again. I am telling you crystallization. Crystallization of an export bill. The rate is TT selling rate.
Okay, sir.
And crystallization of an import bill, it is bill selling rate. In both cases, the rate is selling. In export bill, it is TT selling, and import bill crystallization is bill selling.
Sir, PPTs and textbook syllabus are in a sequential order, sir, or whatever the preference you are putting it in forward first PPT, sir.
The first PPT is your chapter 1 only. First 2 PPTs, and the next 2 session also chapter 1 only. So because next session is on numericals.
Okay.
So all the 3 in chapter 1, from chapter 1. And chapter 1, but next day we have 2 sessions, isn't it? Next Sunday we have 2 sessions, and those 2 sessions, one will be on the numericals, and the next will be for your NRE accounts and basics of forex derivatives. Ours chapter 2 and 3.
Sir, this is only revision, sir. I think you have completed this syllabus earlier, sir.
No. This is for fresh batch is there. For fresh batch, this is beginning. And those, because it's a combined, I understand from Tamil and Telugu batches candidates also, if they are interested, they are participating in this. And then along with that, there is a new batch. So some of the participants are new. They may be hearing for the first time. So that's what I'm starting from the basics.
Sir, we are for hearing it for first time.
Yes. I know that. Yes. But some of you, that's what you are asking. Somebody is asking the FEMA and all. I am not told about FEMA, but still they are asking. That's what you have some knowledge. But when we discuss on FEMA, that time you can come out with your doubt, if any.
Sir, IB, how many classes we can complete, sir?
IB 8 sessions and say 12 hours. 12 hours means it take little more. I may require more than 1 hour 45 minutes for one session because lot of doubts are coming now. If I am muting all of you and I can go on explaining just like a radio, I can complete in 1.5 hours time. But that's not possible. In between you are pardon?
If we complete IB complete sessions, there will be some combined topics for treasury management also, sir.
Treasury management, I think I am taking treasury management from Tuesday onwards, morning. Tuesday, Wednesday, Thursday, Friday and Saturday, I think. 5 sessions on treasury management.
Oh, okay. Thank you, sir.
Morning 5:37.
Sir, this previous slides, if any questions, please send through WhatsApp, sir, so we can solve for all the questions, whatever.
You want? I'll send. I have a series exercise 1. I will send.
Yes, sir.
You can try to do it. I'll send that.
Please send, sir. Okay.
Sir, next class at what time, sir?
Pardon?
Next class at what time, sir?
So how many slides are there in this PPT?
Total slides. I have prepared 8 slides for international banking and 5 slides for 5 set of PPTs for treasury management.
So today's balance slides, sir. Today's balance slides.
Today balance slide. Let me check. 1 second. Share screen. Share screen. After this, it is dealing room system. There are 3 offices. This is 1. Functions. Then USAP 2. Then categorization. It's a very simple thing. 3 types of branches. Category 1, 2, 3. Then FEDI guidelines. This is one. Then another RBI guidelines. Etc. These are all.
When you will share these PPTs?
I'll send it. I'll share it.
Kindly send.
Then some practical situations. I think. Let me escape from this. This card. Then it will be said. Okay. Study 1, 2, 3, 4. 4 questions and the MC.
If anybody wants to
38 slides. And then there is a answer also. Yes.
Please share, sir.
Please share it for yourself so that we'll solve it and we'll ask the doubts in the next one.
Okay, no doubt. You have my number, no?
To make a foreign exchange business, you will have to take up from RBI or FEDI or both.
Pardon?
If anybody wants to have a business in foreign exchange, then from where he will have to get the approval.
You mean next class on IB will be next Sunday.
My question is, if anybody wants to make a business in foreign exchange, from where will they get approval? Either FEDI or RBI?
See, there are a lot of things we will discuss in export and import. The first is they have to get a code. They have to apply to DGFT. We'll discuss all those things. We will just begin the things. No, we have to move further, go a lot. Then it will come. First, they have to apply to DGFT, obtain the code. importer exporter code, IEC code number. It's like PAN number. There is an IEC code number. That is the first step. And after that, okay, can you hear me?
Yes, sir.
Yes, sir.
After that, they have to approach to a bank. He is an exporter. He has to go to a bank, and he can submit the document. He can avail export finance. Those things, the bank will do the things as per the guidelines. So RBI issue a set of guidelines based on FEMA, and based on that, bank can act. This is with respect to export or import.
Okay.
So the movement of goods is regulated by DGFT, and the movement of funds is regulated by RBI. So those things.
So next class will be tomorrow, day after tomorrow.
Okay.
Day after tomorrow, it's a treasury management. That's in the morning session.
For evening?
Thank you.
For evening batches?
Batch, I have no idea, because since I am in Singapore, no, this is 2.5 hours ahead. So evening I cannot take. Yours 7 o'clock, 8 o'clock means here it is 10:30. Then it will end up only at 12. So that's it.
Sir, please share your mobile number.
Yes, you can note down. It is 1 second. But now you can only make a WhatsApp call, or you can send a text message.
Yes.
Yeah, enough, sir. Enough.
Okay. You send either a voice message or a text message, or nine four 96254017. 9496254017. I am J. James.
Please, sir, please write it in the chat notes better.
What you want? Okay. Let me.
Sure. How is it? Sumal diya na?
Sir, forward contract maximum how many months they can book it, sir?
Forward contract normally it is 12 months. 12 months for purchase and sale. Next class already told, no, IB next Sunday, same time, 9:30. The treasury management, there is a morning session that starts from Tuesday to Saturday, 5 sessions. Starts at 5:30 to 7 o'clock.
Thank you, sir.
Thank you, sir.
Bye. Take care. Prepare well.
Thank you, sir.
Yes.
Thank you, sir.
Okay.
Thank you, sir.
Yeah, thank you.
I'll share the 2 sets of PPT as well as 1 set of foreign exchange arithmetic. Biju?
Okay, sir. Yeah, thank you, sir. Thank you very much.
Treasury, you'll start from the beginning, no, sir?
Yes.
Okay, thank you.
Treasury also start from the beginning.
Thank you, sir.
Thank you, sir. Thank you very much, sir.
Bye.
Thank you, sir. Thank you. Okay.
Hello.